Good morning. Good morning. My name is Peter Henry. I'm Dean of the NYU Stern School of Business, and I would love to welcome you here to the SEC NYU Dialogue on Securities Market Regulation. Wonderful to have all of you here this morning. The SEC NYU Dialogues are a collaboration between the Securities and Exchange Commission and NYU Salomon Center for the Study of Financial Institutions. Different from the many other events that either the SEC or NYU Stern hosts, the idea for the dialogues is to intersect, as it were, academic pedagogy and economic evidence with the views of market participants and regulators. Each half-day dialogue focuses on a discrete topic. The dialogues are spearheaded by Scott Bogus, who is the acting chief economist of the SEC, and Alexander Lundquist, who is the Sidney Homer director of the Salomon Center. Many thanks to both of you. The inaugural dialogue was held at the SEC in February and focused on the topic of securities crowdfunding. Today's second dialogue focuses on the topic, reviving the IPO market. As many of you are aware, the past 15 years have seen record low levels of IPO activity. 5 years ago, the Jobs Act was intended to breathe life back into the US IPO market, though the IPO market arguably continues to be weak. Today's dialogue will explore the economic causes and consequences of the continued weak state of the market and discuss ways to revitalize it. Not coincidentally, the Salomon Center hosted an academic conference on these very issues yesterday, and many of yesterday's presenters are in the audience here today. Today's distinguished panelists will bring academic, industry, and regulatory perspectives to bear on these important questions. Before I introduce the Commissioner of the SEC, Michael Pivovar, I would like to extend a warm thanks to all of those who made this event possible, and a special thanks to the staff of the Salomon Center and the SEC who were instrumental in designing today's panels and securing a number of the excellent panels that we have in store for you today. So please give them all a round of applause. As you can see, we have a full and rather large room, so it's really an outstanding turnout, and we're just so pleased to have everyone here, and we're pleased for all of the help the organizers have given us. It's now my pleasure to introduce this morning the Commissioner of the SEC, Michael Pivovar. Before entering public service, Mike was an assistant professor of finance at Iowa State University, where he focused his research on market microstructure and taught courses in corporate finance and investments. He published a number of articles in leading academic journals and received several teaching and research awards. Commissioner subsequently worked in industry, providing economic consulting services to law firms, worked in the Bush White House as a senior economist on the President's Council of Economic Advisors, and then became the Republican chief economist for the U.S. Senate Committee on Banking, Housing, and Urban Affairs, before being appointed to the SEC by President Obama in 2013. He was designated the commissioner of the commission by President Trump in January 2017. Commissioner Pivovar's economic training, background, and approach on market issues resonate with the large number of economists at the SEC and indeed in academia. And as such, it's very fitting that he should open our second SEC NYU Dialogue. Please join me in giving a big, warm NYU Stern welcome to Commissioner Pivovar.
Good morning, and thank you, Dean Henry, for that kind introduction. It's not often that a fellow economist gets to introduce me, so I'm a bit of an odd duck at the Commission. In the history of the SEC, there have only been 3 PhD economists to be commissioners at the SEC. It's mostly an agency of lawyers, and so it's great to be back at the business school, see fellow financial economists, even one of my former professors, Frank Hathaway, from back in the day, and one of my fellow students, Jen Juergens, from back in the day. So it's great to see everyone here. A lot of other familiar faces. We got Ed Fleischman, former SEC commissioner, up there. We got Kathleen Hanley, former deputy director of DERA. We got all kinds of great people here. I want to thank Alexander Lundquist and others from the Salomon Center for the Study for Financial Institutions at NYU, as well as staff in SEC's Division of Economic and Risk Analysis for organizing today's dialogue. I'm happy to join you in this discussion and exchange of ideas on the current state of and outlook for the IPO market in the United States. Now, this event is particularly timely because it coincides with the arrival of Jay Clayton, the SEC's new chairman, as of last week. And for those of you not familiar with how the commission is organized, we have 5 commissioners. We're supposed to have 5 commissioners at the SEC, nominated by the President, confirmed by the Senate, one of which is designated to be the chairman. We're currently down to 3 commissioners. Jay Clayton just arrived last week. He's been designated by President Trump as the new chairman of the SEC. I will go back into my role as being a regular commissioner after having been the acting chairman for the last 3.5 months. I sort of view my role as sort of stepping up to be department chair for a little bit and then stepping back into be sort of a regular faculty member. I'm quite pleased that Chairman Clayton has joined us, and he's made it quite clear, if you've seen any of his public statements or if you've seen any of the statements from the White House as to why President Trump chose him to be the chairman of the SEC, that under his leadership, making public capital markets more attractive to business while providing appropriate safeguards for investors will be the top priority in terms of his tenure as being chairman of the SEC. Now, an IPO has historically been one of the most meaningful steps in the life cycle of a company. Going public gives a growing company access to an important source of funding, the public equity market, allowing it to raise capital from a diverse group of investors, often at a lower cost compared to other funding sources. This capital can be used to hire employees, develop new businesses, develop new products and technologies, and expand operations. The beneficial uses to which that capital may be put are even more pronounced for small companies, because they tend to be more innovative than large companies and they account for a substantial percentage of the jobs created every year. Furthermore, IPOs give successful entrepreneurs an exit strategy for some or all of their investments and provide an opportunity for them to allocate their capital and talent to other productive ventures. The same is true for institutional and other early stage investors. IPOs also have an important implications for employees, for whom a portion of their compensation before the IPO is a promise of future payment from options and stock grants. Through an IPO, such employees can access secondary market trading on the firm's securities and therefore translate anticipated compensation to real dollars. A vibrant IPO market also allows retail investors to add economic exposure from growing firms and industries to their investment portfolios, either directly or through vehicles such as mutual funds. As such, investors can share in the wealth created by these companies and enhance their overall risk diversification. Notably, IPOs can enhance capital formation in both public and private markets. For example, if private sources of capital are aware that companies have a viable financing alternative through public markets, an entrepreneur may be in a better position to realize more favorable financing terms from more sources. The number of value-enhancing projects and innovations thus may increase. In addition, an active IPO market can enhance efficient decision-making among suppliers of capital. The robust disclosures generated by newly public firms provide investors information to better evaluate investment options because they serve as benchmarks versus other companies, both public and private. When complemented with the information provided to the market by third parties such as securities analysts, disclosures by IPO firms provide an important layer of investor protection that typically is not available in private markets. Given all of the benefits I just articulated, the importance of IPOs to the U.S. economy cannot be overstated. In a nutshell, a robust IPO market encourages entrepreneurship, facilitates growth, creates jobs, and fosters innovation, while providing attractive opportunities for investors to increase their wealth and mitigate risk. For decades, the United States enjoyed a strong IPO market that produced a steady supply of newly public firms and allowed millions of investors to participate in the value creation generated by these firms. Many foreign companies chose to go public in the United States, which gave U.S. investors global investment options to diversify portfolios. For those foreign companies, an IPO in the United States enabled them to expand their funding sources and take advantage of a lower cost of capital compared to their domestic markets. In fact, between 30 and 50% of worldwide IPOs on an annual basis occurred in the United States during the 1990s. In the last 15 years, however, the reduction in IPO activity has been dramatic. For example, since 2000, the average number of annual IPOs is 135, less than one-third the average annual number of IPOs, 457, in the 1990s. This decline has occurred despite the fact that there has been no downward trend in the creation of new companies over the same period. Traditional economic factors such as fluctuation in companies' demand for capital and changes in investor sentiment also cannot explain the large decrease. Strikingly, the fraction of worldwide IPOs occurring on U.S. markets fell below 10% between 2007 and 2011. The substantial drop in the number of IPOs in the United States is primarily driven by the disappearance of small IPOs. In the 1980s and 1990s, IPOs with proceeds of less than $30 million constituted approximately 60% in the 1980s and 30% in the 1990s of all IPOs. In fact, some of the most iconic and innovative U.S. companies, such as Apple, Cisco, and Genentech, entered the public market as small IPOs. This trend reversed in the 2000s. IPO with proceeds of less than $30 million accounted for only 10% of all IPOs in the period of 2000 to 2015. By comparison, large IPOs have increased from 13% in the 1990s to approximately 45% of all IPOs since then. What caused this precipitous decline in IPOs, particularly those of small firms after 2000? Today's event is intended to identify and discuss the potential causes and consequences. I suspect panelists will highlight a variety of factors that have contributed to making it more difficult or less attractive for small companies to go public. For instance, the availability of alternative sources of capital, such as from private equity, hedge funds, and even mutual funds, mean that private firms may be able to finance growth without having to go public. The emergence of trading venues that provide liquidity for privately held shares has had the same effect. In the interest of time, let me just quickly list several other possibilities. New offering methods, namely crowdfunding and Regulation A, or our new Regulation A+, have provided alternatives to the IPO. Consolidation in investment banking and brokerage services has left fewer underwriters for small IPOs. Changes in the economic environment due to globalization, along with the winner-takes-all trend in some industries, means that firms have to get bigger faster to improve profitability, and therefore may prefer being acquired by a large company instead of growing organically. Macroeconomic factors, such as cheaper debt financing and increased mergers and acquisitions activity, may also play a role. Moreover, regulatory changes, we always have to turn the mirror onto us and see if this problem is maybe us. Regulatory changes may have contributed to the downward trend in IPOs. The Sarbanes-Oxley Act of 2000 imposed higher regulatory burdens on smaller public companies. Decimalization and Regulation NMS changed the economics of market making for small company stocks and left fewer market makers willing to organize a market for small stocks post-IPO. modifications to the Section 12G shareholder threshold introduced by the Jumpstart Our Business Startups, or JOBS Act, in 2012, also make it more likely that companies will stay private for a longer period of time. What then can be done to revitalize the IPO market, particularly for smaller companies? Now, as a start, during my tenure as acting chairman, the Commission adopted amendments to conform our rules and forms to Title I of the JOBS Act. Specifically, Title I of the JOBS Act provided an IPO on-ramp for emerging growth companies, allowing them to use scaled disclosure for a certain period of time. It also improved the information available for IPO firms by allowing analyst reports to be published during the so-called quiet period. I hope that today's dialogue will generate even more interesting insights and ideas. I look forward to hearing your discussions, analyses, and recommendations. Both Chairman Clayton and I are especially interested in any suggestions for regulatory reforms that could be implemented to reverse the more than decade-long decline in U.S. IPOs. Thank you all for agreeing to spend your time with us so we can benefit from your perspectives, and I wish you a day full of enjoyable and fruitful discussions. Thank you.
Let's go ahead and everybody set up here, and then we'll start off and rotate. Thank you all for coming. Welcome to all the participants many have come from a long distance, the West Coast and UK, to come talk about a very important topic, how to revitalize the IPO market. Our first panel is we have three very distinguished finance professors who are going to set the stage for how we think about the IPO market, some of the economic framework, causes and consequences, and why we should care about a potentially weak IPO market. And immediately to my right, we have Renee Stoltz from Ohio State University, followed by Ronnie McKaylee from Cornell, and Alexander Lengfist, the director of the Salomon Center, our co-host, co-sponsor of the event. And the three of them are each going to give a small presentation, about a 15-minute presentation. Renee's going to set the stage. Ronnie has the hardest job of all. He went to the IPO academic event yesterday and is going to summarize some of the most recent research on the topic, and then Alexander is going to tell us why we care and what are some of the economic consequences of a weak IPO market. And we'll follow that by about 15 minutes of Q&A. So please get your questions ready. And so Renee, kick us off. Right up here should be fine. Yes.
Okay. Well, good morning. It's a pleasure to be here. As Scott said, my role is to set the stage, and kind of the centerpiece of the stage is this. Now, that's a number of listings in the US since 1975, and you can see that it increases steadily until 1997, and then has a pretty dramatic collapse. Now, the key fact here is that the number of listings drops by about 50% since 1997, and we have fewer listings in the US than in 1975, and by a substantial number, by about 1,000. So that's kind of the key fact that we have to focus on. Now, so for a firm to go public, there is a cost to going public. Now, there is a cost to the IPO process. It has to be that the present value of the benefits of being public is going to exceed that cost. Okay, and so you can have fewer listed firms if the value of the benefits of being public falls, or if the cost of going public increase. So that's kind of the framework that I will talk from. And now the kind of the conclusion, at least on my side, is that the biggest issue is on this side, not on that side. No, that's the biggest issue, is that the benefits of being public have dropped, and have dropped substantially, and that's what we have to deal with, and that's what we have to worry about. I'm not going to talk about the consequences. No, Alexander is going to do that. So I will talk about now the kind of the key facts that bear to this benefit of being public, and then I will review the facts using this simple framework that I just mentioned. Okay, the first fact that I think is absolutely critical is that the collapse of listings is something that U.S. made. It's in the U.S. It's not across the world. Okay, what we have here is the number of listings in the world. That's a solid red line. And this is from my paper on the U.S. listing gap, which is in the Journal of Financial Economics in March of this year. Now, if you look at listings across the world, the number has increased and keeps increasing. The black line is the U.S., and the dotted line is the developed countries. Okay, and that's a constant sample of countries. There's been no collapse for the developed countries. Okay, so the rate of increase is pretty close to zero over the last few years, but there has been no collapse. So the collapse is for the U.S., and if you rank the percentage drop of listings, okay, the country that is closest to us is Venezuela. So in the paper that I just mentioned, we tried to predict how many listings the U.S. would have if kind of the relation between listings and institutions and financial development and economic development was the same for the U.S. as for the rest of the world. Okay, so we use the rest of the world to predict listings in the U.S. In the 1990s, the U.S. is just about on what you would expect. Okay, but since then, the number of listings in the U.S. has developed a gap relative to what you would predict from the rest of the world, and this gap is quite large. Now we are talking about missing listings of the order of 5,000 missing listings. Now you can have lots of different models, and you can play with that in all sorts of ways, but bottom line is you always end up with a massive gap. So where did it come from? Here we have the new list, the dead lists, since 1975. The red are the dead lists, the blue are the new lists, so the IPOs. And you can see that two things are going on. And I think it's important to talk about both. One is very low new lists, so very low IPOs, but also very high dead lists rate. Now, so a lot of firms exit, few firms come in. And so the listing gap comes from both, and almost in equal parts from both. Now, so the dead lists are quite important part of the story. And I think the other speakers are going to talk more about that. When you look at the dead lists over time, the big component of the dead lists is mergers. Now that explains a lot of what is going on. Dead lists for cause don't really seem to be a big part of the story, except possibly around 2000, 2001. There's been a huge amount of discussion about firms going private, on that's a big issue. If you have field glasses in the audience, you can see the firms going private. It's the blue stuff down here. Okay, in the big picture, it doesn't matter. The fraction of firms with low market cap has literally collapsed. Okay, and so if you think of firms with less than $100 million of market cap in 2015 dollars, so adjusting for inflation, you go back in 1975, 60% of the firms had that low market cap. You go to today, and it's 20%. Okay, so that's really dramatic. Now, at the same time that we have this collapse, now you want to ask yourself, how are the firms doing that are listed? And one big story there is a lot of firms are making losses. That's a fraction of firms in the exchanges that are making losses. And now when you look at this, during the last 15 years, we had a number of periods, a number of years where more than 40% of the firms were making losses. So lots of firms aren't doing that well. But when you look at the large firms are doing quite well. Okay, and all the other firms aren't doing that well on average. So what we have here is the average ROA for the top decile in assets, and you can see that no, it drops negative in 2001, but that's the only year. Those firms are doing well. The average for the other 9 deciles has been negative most years. Another way to see that is suppose you rank the firm by earnings. Okay, and you take the top 200 firms in earnings. Together, those firms earn as much as all listed firms together. Now, which means that the 3,600 other listed firms on net earn nothing. Okay. The other change that is really important in understanding what is going on is the growing importance of R&D. Okay, and so here what we have is an equally weighted average. Now, if you want to know more about it, it's in this paper that is forthcoming in the Journal of Economic Perspectives. But so if you do the equally weighted average of R&D on assets, now, so you do the average for the listed firms, you can see that it increased quite a bit. And in the early 2000s, that line crosses capital expenditure to asset. Now, capital expenditures to assets has decreased quite a bit for American firms, and that is a case whether you look at equally weighted averages or asset-weighted averages. So we have now a group of listed firms that is changing, and where R&D is much more important. The last slide on kind of the facts is this one. This one looks at the total across all listed firms. Now, so it's not equally weighted, it's just the total. Okay, and the red line, the red continuous line is net investment by those firms, which is really CapEx on inventory investment. And you can see that it dropped in the early 2000s. No, it's the low investment that everybody's talking about. And cash flows haven't dropped. So we have this wedge between cash flows and investment that developed. As a result of that wedge, the listed corporate sector actually has been not demanding capital, not demanding equity, but repurchasing more than they issued on net. Okay, so the corporate sector since shortly after 2000 is a net repurchaser of equity rather than a net issuer equity. Now, so if you think about one role of public markets is to facilitate equity issuance, but obviously if the corporate sector as a whole is repurchasing rather than issuing, that makes public markets a bit less relevant to it. Okay, and so this here is closely tied not to the cost of IPOs, but it's tied to the fact that investment fell. So key takeaways here. Now we have fewer public firms than in 1975. We have a steady decrease since 1997. Now 1997 was the peak of public firms due to mergers and low IPOs. We have a dramatic drop in small firms on the public markets. Large firms are doing well, but the others on average are not. CapEx has dropped, R&D has increased, and then firms are repurchasing on net more than they are issuing. So what does that tell us about the benefits and kind of what are the issues affecting the benefits? Well, if you look at what happened in the 90s and since then, now the institutional investors have increased in importance dramatically. Investing, now the commissioner was talking about firms with a market cap of 30 million. Now, investing in such a market cap for an institutional investor is a proposition that doesn't make a lot of sense. Now, if you're an institutional investor, you want firms, you want to do things on a scale that makes sense for the size of the portfolios that you are managing on the resources you have. So institutional investors kind of tilt the market towards larger firms. That's where the demand services from the banks and so on. The second fact is the growing importance of R&D that we saw. Now you finance R&D differently than you finance fixed assets. You can use fixed assets as collateral. You can't really use R&D as collateral. Okay, and so R&D is harder to finance publicly than fixed assets to finance publicly. Now the danger with financing R&D publicly through the equity market is that you have to tell people what you are doing, and if you tell them, then somebody might use it against you. The growing importance of outsourcing affects the use of public markets because now the key fact about this outsourcing, it's not US firms outsourcing to firms in the US. Now if it was US firms outsourcing to firms in the US, then we would see investment growing in the US. It's firms outsourcing to firms in China, okay? And so the public firms invest less because they are acquiring things produced by firms that are in China and elsewhere. But that means that the US firms don't need as many capital assets as they would. Now think of how the balance sheet of Apple would look like if Apple was manufacturing all the iPhones. And think about how their capex would have looked like over the last 15 years. That would be completely different. Now the internet and changes in financial intermediation are also a big part of the story. Okay? Because the internet lowers search costs. It makes it a lot easier to find investors. It makes it a lot easier to find information. And then private equity came in on intermediates in such a way that you can raise enormous amounts of funds, either as equity or as debt, without accessing the public markets. The last piece of the puzzle now is that small firms seem to be struggling quite a bit to kind of exploit economies of scope, both because of the speed of innovation and because of the fact that we're in a global playing field. So if you want to build yourself quickly, you have to be having an impact globally, and that's hard to do when you are a small firm. Now, and you might be much better off being acquired than developing yourself kind of the old-fashioned way. What about regulation? Now, people talk about SOX, keep talking about SOX. No question that there are aspects of SOX that could be improved, but no, the going private transactions are not a big deal. Okay, so in that, that's one reason why SOX is not the key piece to understanding what's going on. The other part of now the data I showed is that the drop starts in 1997. Okay, and so I would think that nobody expected SOX in 1997. Okay, so much of these gaps that we talk about developed way before SOX even applied. Now the section on controls applied to small firms that took quite a long time. So SOX is not a big part of the story. The one thing to remember about regulation, okay, now you can think of exchanges on being listed as a club, okay, and paying the membership fee of a club requires a club to be something that's worth participating in. If you have no regulation and everybody can go and everybody can do anything, nobody will want to be part of the club. No, so there's a positive side to regulation and there is a negative side. And the balance between the two is not something that's easy to do. But no, there is an optimal amount, and the people at the SEC earn their pay by trying to figure out what that balance is. what about IPO costs as a part of the story? Well, I just don't see it. I mean, IPO costs have now, if anything, kind of fallen. They certainly haven't increased. No, so the whole story is on the side of the benefits of being public. So last slide. No, I mean, one thing that is pretty unique to the U.S. is that the playing field is more tilted against listed companies in the U.S. than it is in many countries. Now, having public companies means that you get price signals. Private companies free ride on those price signals. Now, so if we don't have those price signals, allocation of capital is not going to be efficient for the country as a whole. So it's a big deal. Okay? But the private firms avoid a lot of stuff. Now, in the U.S., federal regulation of firms goes through the securities laws, so if you don't go public, you are not subject to that. Think of the minerals part of Dodd-Frank. Now, if you're a private firm, you don't have that. So we need to tilt the playing field back to be even. And rather than thinking of regulation of IPOs, which I don't think are going to achieve much in that, we have to think of, now, what can we do for public firms to make it more attractive? My humble proposal is makes dividends for public firms tax deductible, but not for private firms. Thank you.
And on that, note, Ronnie is going to give his view on the most recent literature on IPOs and his perspective.
Someone clicking? Okay. Thank you. Good morning. I'm actually from Cornell, but also from Cornell Tech, and there is one rule we cannot break at Cornell Tech. We're not allowed to wear ties. So I agree and very much appreciate the review and the perspective that Renee gave here. I'm going to start actually, we have a few slides that are almost identical, but other than that, I'm going to take it to a slightly different direction. As you see from the title, which is, should we really revive the IPO market? And Renee hinted at it a little bit, and I'm going to actually elaborate it a little bit more. Maybe that's not the main objective, or even saying it more provocatively, that the issue that we are facing, the IPO market, is a sideshow. It's not the main show where we have to fix things. Oops, why? It's not going down for some reason. Jennifer, you're in charge of that, okay? Okay, thank you.
Okay.
Thank you. Okay. So I'm going to focus here on three aspects, and I'm going to weave in some of the insights, not all the insights, but some of the insights that we've gained yesterday. The first one is the market is changing. Then really to understand a little bit better of where we should focus and why we should focus on one aspect or another. I'm going to talk a little bit about why companies go public. Almost the article of faith, and we heard it also in the commissioner opening statement, is that companies go public because they need cash. Sort of a lot of the academic literature that deal with this issue actually challenge this view, empirically, not theoretically. So I'm going to review it a little bit because I think it's important to the debate that we're having here. And then I'm going to end with really, should we really be concerned with what's going on with IPOs? And if so, what can be done? I did not think about dividend taxes, which I should have given my research, but I'm going to sort of offer a few other recommendations. This is actually a graphical description of what the commissioner said in the opening statement. What you see here is the evolution of IPOs, both in terms of the numbers of IPOs over the last 40 years or so, and you see a very significant decline in the number of IPOs. The picture, by the way, looks a little bit less bleak if you don't pay attention so much to the number of IPO, but to the dollar raise, and this is the sort of the solid line. Still definitely decline, but sort of to a lesser extent. This is an identical picture that Renee and I had, which is saying, okay, there are some consequences to this. I will not elaborate on this. We have already heard it. There is a dramatic decline of about 50% in the number of publicly traded firms. This decline is widespread. It's not just in dying industries. It's really across all industries. You see here that about 90% of the industries have experienced a decline in the number of publicly traded firms. This decline also is associated with increase in real term in the size of the publicly traded firm, actually triple in size both in terms of mean and median of the size of the publicly traded firm. Good or bad, that I'm going to show you in a few slides, but these are sort of the empirical facts. And really, as far as I'm concerned, the elephant in the room is the fact that what we're seeing, and that's the big issue, is increasing concentration in the U.S. industries. Again, this is what you see here. This chart is the Herfindahl Index. It's a measure of concentration that at the same time that you've seen in Renee's slide and my slide around the end of the 1990s, a dramatic increase in concentration. Again, this increase in concentration is not in one industry, but spread across all industries. This is actually looking only at the publicly traded firm, but the picture is going to be the same if we are looking at both public and private firms. For example, here you see the market share of the 4 largest firms in the industry, both public and private. Okay, you see increase across industries. Over 75% of the industries, we see an increase in the share of the largest firm, consistent, by the way, with one of the slides that Renee showed about the profitability of the largest, I think it was 200 firms. But it's important to notice that it's not something just because of decline in the public market. Okay, whether we look at the largest 4 firms, or here we look again at the Herfindahl Index, but taking from the census, which has information both on public and private firm, we see the same phenomena. Include both private, public. The phenomena is a significant increase in concentration in those industries, or actually in most industries. What are the consequences? Empirical consequence that we see of this increase in concentration is increase in profitability, increase in profit margin. So it's not only because of efficiency, or mainly not because of efficiency, but actually because they can actually take advantage of their monopolistic power, increase in return to shareholders in those industries or in those large firms that Renee mentioned before. Without going too much into the details, our view is that the reason for that is regulatory changes in terms of the enforcement policy, not in terms of the regulation, the laws in itself. And probably equally important, if not more important, is the technological innovation or the increasing return to scale that also was sort of mentioned by Renee. So these together yield an environment that is different than what we were used to. And the question that we want to ask is the decline in the IPO the reason or a sideshow really? Is really if we are going to change regulation for IPOs and decimalization, increase, right? I think it's like deregulation, decimalization, instead of 1 cent, we are going to increase the minimum bidder spread to 5 cents. Will this change this trend? I doubt it. Whether we're going to make IPOs easier to go to the market and sort of do more of the Job Act, I personally doubt that this is going to sort of to change the trend. But to better understand it, let me go and talk a little bit about why firms go public. And the obvious reason that all of us are thinking about is because they need cash. But think about it, even if they need cash, we still have to ask the question, okay, they need cash, but they have many ways, especially nowadays, to get cash. They can get cash through debt, they can get cash in the private market. They not necessarily have to go public for that. But even if we're putting this one aside for a second, what is really the evidence? So one of the nicest papers, academic paper on this, is by Pagano et al., that actually find the main reason for going public is not the need for cash, but rather market timing. So when markets are high, when valuations are high, this is where companies tend to raise money. In fact, they don't find much change in investment post-IPOs, which is interesting. Now, it's true, this is not Venezuela, but it's Italy, so maybe it doesn't tell us as much about the US, but it's not the only studies. Another study actually basically asked CFOs, asking 330 and so CFO why the firm went public. No evidence the need for cash is the driving behind the IPO decision. Examining what firms are doing in the US, what firms are doing with the proceeds for IPO, we see that about 40% of the cash that they raise is still in their coffins 4 years out. And about 30% was used for increased investment. Overall, the need for cash is a factor, but does not seem to play the only role or the dominant role that one might have expected. And as I said, the need for cash can be achieved through other means. For example, one of the papers that we've seen here yesterday, presented by Michelle Laurie, shown one innovative way or new way that a firm get their cash privately, and this is actually through she concentrate on mutual funds. And you see here the increase in mutual fund financing of private firms. Okay, we're not even talking about PE firms, we're not talking about hedge funds, we're talking about mutual funds, and you see here a dramatic increase in the financing of mutual funds from basically 3 to 93. Mutual funds are increasingly providing funding for private firms. More funds participating in that, more private firms receiving the capital. Mutual fund investments are concentrated in firms within the later stage, naturally the larger firm. And to summarize this study, early in sample period, going public provided access to substantial new source of capital. Now, this capital is increasingly available to firms while they're still private. And again, looking at mutual funds is interesting because, in a way, they're the last source of fund one may expect to private firm. We have many more in the line, so it's even got to this type of firm. Other reason, I'm not going to name all the other reasons for going public, but few that are I think are interesting is first the issue that I mentioned of overvaluation. Empirical finding again suggests not only the study that I mentioned, but that investor sentiment, the proxy for overvaluation is also consistent with this as a motive to go private. Exit strategy. This is just from today, New York Times. Actually announced that it's going to go public with its U.S. operation. Stated explicitly, company is what they're going to do, either reinvest in the company main business or return to shareholders. Okay, so basically return to shareholder either through untaxed dividend, if you guys listen to Renee, or maybe to not only to shareholder but also to debt holder and reduce the amount of debt that it has and doing some recapitalization. An important and sometimes overlooked is actually the issue of owner diversification. I'll tell you in a second why I think it's overlooked. Private firms held by less diversified controlling shareholders are more likely to go public. This is a finding of a study that was published in the Review of Financial Studies several years ago. Less diversified individual shareholders sell more of the shares in the IPO. So basically the reason that I want to go public is because I want to diversify a little bit my holding. And the third bullet point in a way is the most important from macroeconomic point of view, that there is evidence and theory that support the statement that actually greater diversification lead to better investment, and put here better in quote, because it may not be better in economic sense, but actually lead at least to higher growth in terms of the investment decision. So it's a reason for policymaker. The reason why I want to emphasize that, it is a reason for policymaker to say, okay, so maybe going public really has advantage over being private because investors are more diversified and therefore are making better investment decisions. Another important point that came out also yesterday, I think Michael is here somewhere in the audience, the issue of certification. I was surprised to learn that I still don't believe it, but Michael, I'm going to blame it on Michael, that actually that private firms don't have to basically to report by GAAP or being audited. I invest in a lot of private firms. I didn't even realize that. I thought that they are audited, but that's a big difference. Okay, now think about whether you're a mutual fund or whether you're a private investor, you invest in private firms, though if those firms are not being audited. Okay, so you can think about being private is not only the having analysts as watchdogs, but in fact just having the simple thing as sort of reasonable accounting standard. And those reasonable accounting standards is not only beneficial in terms of what the public think about you, but it allows manager to really make better decisions because they have, in all likelihood, a better picture of what's going on in the firm. Impact on valuation, as I said, impact on firm decision. Seems like to have a significant difference between private and public firms. And this leads me perfect. Okay, this really leads me to sort of one of the big picture question, which is going public as a public good. Okay, so not only sort of as policymakers and regulators, one of the things that we may want to ask ourselves is, okay, it's very nice if one company benefit or another company benefit or not, but really what it does to the economy as a whole. And I think the bullet point that we have to think about is, does really going public lower the cost of capital relative to existing alternatives? My reading of the literature, actually the evidence is not clear on this. Do we have better allocation of capital? I personally believe yes, but there is not strong empirical evidence that suggests to that. Hopefully Michael continue with his research and show some evidence about that. Higher growth in the economy. Again, yesterday we had two interesting papers that indirectly at least allude to this point. One was by Page Oyman that actually showed that IPOs lead to the creation of other new startups by people that after the IPO leave the newly traded company and start their own company or their own startup. Having said that, the very same thing can happen also when you have an exit strategy through acquisition. I presume the founders and other of the software engineer or whatever will do the very same thing. It's not the private public that makes the difference, but being suddenly a bigger company with more control. Sabrina Howell showed, using Chinese data, she showed that actually IPO suspension, when suddenly there are no IPOs, it's lead to fewer innovation or fewer patents, suggesting that maybe there is something in being public that does foster some innovation. Certainly we need a little bit more research on that before coming to definitive conclusion. It has better monitoring. Okay, in the big picture, do we really have better monitoring with public firm relative to private firm? And this one related to how does this compare to the alternative today, not 20 years ago. How does this compare to the alternative today? Last but not least point here is not from the perspective of the company or cost of capital, but actually from the perspective of the investing public. For me, one of the biggest disadvantages, the way I see it, of private firms is that many people in this room, maybe this room is not a good example, all of you are money managers of billions of dollars, but at least many people in the first row are unable to invest in private firms. And it's true for most of the investing public. And having a public firm allow us the small investors to better diversify our portfolio. That's very important. The role of regulator, SEC, and others is not only to the lower cost of capital to companies, but in fact to enable also small investors to enjoy the role of diversification, which is very, very important in my opinion. Last slide. What can or should policymakers and regulators do? I have to be careful because Colleen gave me a hard time yesterday about regulators, policymakers, not the same. So I wrote both of them. So first, identify the main issue. As far as I'm concerned, the main issue is the reduction in competition in the US. And this is because increasing barrier to entries and maybe some other regulations that are really related to the Department of Justice and the FTC, not necessary to the SEC. That's the main thing. Can change in law and regulation concerning IPO change a trend? I doubt it. That's actually similar. Renee came to it from different perspective. I doubt it. The SEC, the Job Act, the de-decimalization. A paper yesterday showed there is no evidence of decreased information efficiency due to this de-decimalization or dissemination. That means changing from 1 cent to 5 cents will not make a big difference anyhow. Job Act seems to have a small effect on IPO activity, but even this effect is dampened by the fact that it seems to be increase in analyst bias. We've seen yesterday a paper about that. My recommendation actually is not about dividend taxation, but actually for the SEC and the other regulators to make, rather than try to fight the trend, try to make private firm look more like public. I mean, I don't think we really care whether the firm is public or private from a philosophical perspective, okay? If they can get access to lower cost of capital, if they can allow us as investors to invest and diversify, we're good, okay? It's not like a goal in and of itself to have more public firms. And I think the way to do it is actually through regulation that will make private firms look more like public firms.
Thank you, Ronnie. Alexander?
Okay, good morning. It's my privilege to go last of the first panel of speakers. And that's usually an opportunity to disagree without any consequences, because you're doing last and nobody can really contradict you. But amazingly, Renee, Ronnie, and I are actually on the same page. So you're going to hear me reiterate some of the things that Renee and Ronnie were talking about. All right, my task is to talk about the economic consequences. And by its very nature, this is either something that is speculative, because it may not have happened yet. Maybe we haven't yet reached a tipping point where these economic consequences become severe enough for us to look at. Or it's something that economists haven't looked at enough yet, even if it has already happened. So you're going to see a lot of question marks behind my statements on the slides that follow. So they're speculative in the degree that perhaps they haven't happened, or perhaps we don't know the answer yet. I think it's important to broaden out the investigation beyond just looking at IPOs, as did Renee, as did Ronnie. The IPO market and its decline in activity is part of a broader trend of a decline in demand for listings. And you've seen a version of this slide, but I prefer mine because it goes back to 1925. So we've got almost 100 years here of listing data. And of course, the stunning fact is that the number of listed firms on the three main exchanges, now two, has halved since 1997. And in fact, in my lifetime, there have never been fewer listed firms in the US than there are today. I share a birth year with NASDAQ. Now you can show the data differently, and I think that's going to bring out some of the interesting patterns here that Renee already alluded to. Here's the year-to-year change in listings. And if you look at the time after NASDAQ was created, you had long periods of time of net increases in the number of listed firms. So the exchanges collectively grew as far as the number of listed firms is concerned. But for the last 20 years or so, we've had year after year after year after year of a net decline in the number of listed firms, with the one little exception of 2014, where people were getting very excited, but that trend so far hasn't continued. And then you can unpack this even more and think about not the net change, but the gross changes in terms of new listings and delistings. And this is where I link up with Renee. I think it's very important to think about not just a decline in the number of IPOs, but also what's happening on the delisting side of things. And we've had a very steady rate of delistings. And the way that I view the inactivity in the IPO market is as failing to replenish the pool of listed firms that has this natural outflow through either bankruptcies, obviously, voluntary delistings through private equity buyouts, and of course, mergers amongst listed firms. So what we should be seeing is that we have new blood joining the markets, and that's the bit that hasn't really happened. All right. Now, the framework that I'm going to suggest, Renee was talking about costs and benefits, is one that I think we should bear in mind as we think about how to reform, and indeed whether we should reform, the rules surrounding the market and so on. So why should we care? The starting point is that everybody is privately optimizing. On the demand side, demand for listings, you've got firms that choose to delist. You've got firms that choose never to list in the first place. And those choices, those decisions are privately optimal. They're trading off the costs and the benefits that Renee talked about and that Ronnie talked about. And there's nothing wrong with economic agents making their own privately optimal decisions. And there's no reason for regulators or any of us in this room to tell them otherwise. That's on the demand side. On the supply side, supply of capital side, we've got private optimizing by agents. We've got institutional investors, we've got investment banks, we've got analysts, having chosen over the last 20 years to focus their attention on large cap stocks. And that is optimal for them, given the cost structure and the benefits that they're seeing in the marketplace. You've got retail investors that have changed their focus away from investing in IPO companies and indeed investing in individual companies, and instead are favoring ETFs and perhaps large cap stocks, and perhaps indexing their portfolios and so on. And they're doing that out of their private optimization concerns. And again, there's nothing wrong with that. So for us in this room to be concerned about the shrinking of the stock market and the decline in IPO activity, we need something else. And that something else is that we can have a misalignment between what's privately optimal to do and what's good for the economy, what the socially optimal decision might look like. So this is the wedge that we need to be looking for. And if we can't find one, then we can go home early today, because there's no cause for concern. So to an economist, what I'm talking about is externalities. And externalities can be positive or negative. So it can either be something that will affect others who are not party to the decision being made by privately optimizing agents. And those collateral damages or collateral benefits could be positive or negative. So just to remind you, Economics 101, and I just finished teaching, so I can't help myself. A negative externality arises when a third party becomes affected by a decision that somebody else makes and bears a cost as a result of that decision. So the textbook example is that you've got a factory that decides how much to pollute the air, and they're minimizing their cost with respect to emissions control and so on and so forth, and they're doing it obviously within the law. But what they're not taking into account is the external effects of their decision, namely the externalities that they impose on the health of people living in the surrounding area, and therefore the medical costs that are borne privately by people who are not subject, who are not party to the original decision. So you're going to have too much pollution relative to the social optimum because the polluter doesn't take into account the consequences of their action all the way. Positive externalities exist as well, and there you've got a third party benefiting from a decision that's privately reached. And perhaps a good example of that is if you decide to immunize your children against various diseases, you're conferring a benefit on everybody else by doing so because of this phenomenon of herd immunity, reducing the incidence of infection across the population. More people decide to immunize their children. So you could free ride on this and not immunize your children, not bear the small risks of doing so, but you're benefiting from everybody else's decisions. So back into our world here, thinking about the state of markets, we're looking for these kinds of external effects of the privately optimal decisions being made by market participants. So what I'm going to suggest is that there might be External effects, externalities that we should be concerned about. This is the bit that's speculative. These may or may not happen. These may or may not already have happened. Economists have not studied these effects enough. So you're going to see a lot of question marks here. I'll suggest 5 negative externalities, and then for balance, I'll suggest 1 potential positive externality, and then we'll see where the discussion takes us for the rest of the day. So my first negative externality is that by not going public, or by delisting, firms may end up investing less, which could lead to less innovation, less job creation, and so on. So why am I concerned? I'm concerned because we think we know, and I think this is true, public markets provide capital at a lower cost than private markets. So if you are a founder of a firm somewhere in Silicon Valley, and you decide to stay private, then you're perhaps trading off the increase in the cost of capital that staying private entails, and the benefits that you derive from staying in control of your creation. So you're trading off the control and the cost of capital. And you're doing so optimally. But what that means is that with a higher cost of capital, you will end up, presumably, investing less, and then innovating less, and then creating fewer jobs, all else equal. Question mark. Now, I'll come back when I talk about positive externalities, this all else equal, because that might not be equal. So it's negative externality potential number 1. Negative externality potential number 2 is capital misallocation. Ronnie hinted at this. Ronnie hinted at a lot of things that I'm going to be picking up on. The notion that I have here is that we know disclosure requirements are a lot higher in the public markets than in the private markets, and in many ways the private markets are completely unregulated as far as disclosure is concerned. That allows, in the public markets, scrutiny by a variety of actors, such as investors, the media, activist investors, analysts, and so on, that can cast an eye on what management get up to and give their verdict on what is going on. And if they disagree, they can sell the stock or sell the stock short to provide a signal back to management and put pressure on management. So we have an element of price discovery in the public markets that is absent in the private markets. So by choosing to stay private, or by not going public in the first place, you have less scope for spotting management folly. You have less scope for spotting the emergence of bubbles, either in terms of capital allocation by institutional investors, venture capitalists, and so on. And you have fewer mechanisms to provide the feedback back to the companies concerned and pull the plug on trends that are negative. So maybe we don't need 15 Uber clones. Maybe we don't need 30 Airbnb clones and so on. Maybe we've over-allocated capital to various sectors, but there isn't really a good mechanism of spotting that early enough, which could lead to capital misallocation. Potential externality number 3, and here I'm very grateful to Ronnie for having shown you the elephant in the room, and I completely agree with him, is potential harm to consumers. So if you're a company, let's say WhatsApp, in the private markets, and you agree to sell out to Facebook, then presumably you're doing that because privately this is optimal for you, given the price that you're being offered and the other considerations that come into play. But what you're not taking into account, and indeed you have no reason to take into account, is that by being acquired, you're not going to give yourself a chance to evolve into a strong competitor to the established players out there. And therefore you're diminishing, we will never observe this because it didn't happen, but you're diminishing the competition that could have otherwise have happened. And I think this is a difficult to capture, but conceptually very important harm that we should be concerned about. And I think this is happening already. So I'm going to show you here a slide that shows you the number of VC-backed companies that are exited by their VC backers going back to 1980. So it's literally the annual number of VC-backed companies that are sold, broken down by whether they went public, that's in red, or whether they're sold to somebody else, a Pfizer, Google, and so on, and that's in gray. And what you can see here is that the norm in VC land used to be that you're selling your companies on the exchanges. And that's completely flipped starting in the mid-1990s and has basically disappeared as far as IPOs are concerned in the 2000s. So what the VC is already doing is selling out to the established players in their various industries, which is reducing the potential growth in competition going forward. Externality number 4 is that we might have less political support for shareholder capitalism. So the notion of shareholder capitalism goes back 100 years, and just 2 examples here, taken from the 1920s, where you have companies trying to broaden their share ownership amongst retail investors, specifically to influence political processes. For example, AT&T pioneered employee share ownership programs in order to combat the rise of unions in the 1920s. And utilities involved their customers as shareholders in order to get a constituency to speak on their behalf when regulators became too onerous as far as the utilities were concerned. So the idea of anchoring shareholder capitalism in the population and influencing political processes has a very long tradition. And indeed, President Bush came back to this idea. He called it the Ownership Society in 2004 when he said, I think government ought to promote an ownership society. Why? If you own something, you have a vital stake in the future of our country. The more ownership there is in America, the more vitality there is in America, and more people have a vital stake in the future of this country, which I would then take and say, and that will provide political support for growth-friendly policies, business-friendly policies, trade-friendly policies, and so on. Now, what if this process is going into reverse? Will we have less support politically for those kinds of good policies? And I think there is cause for concern. Here's the same number of listed firms graph. You see the decline since 1997. And I've overlaid on that stock market participation, which has raised the fraction of households in the US that own stocks in the stock market. And that's tracked the number of listed firms really very beautifully. And it's declined since the peak was reached in 1997. So maybe we already have much less engagement with capitalism through direct share ownership than we've ever had. And therefore we should perhaps be concerned about the political consequences of this. This is speculative. Finally, maybe we need to be concerned about increased wealth inequality as a result of firms voluntarily staying private or going private. So there's a key difference, Ronnie hinted at this, between public and private companies when it comes to access. Anybody can buy shares in the public markets. Anybody can buy shares in Alibaba, Alphabet, Amazon, Apple, to just name 4 well-known companies that start with A. But for you to buy shares in Airbnb, Pinterest, Uber, and so on, you need access. And access is something that is very uneven. So the rich, quote unquote, already have access. You can invest directly. Ronnie said he invests in many private companies. Ronnie has self-identified as rich. Or they can invest as LPs in VC funds. Whilst the average Joe obviously doesn't typically have direct access. There are regulations in place that prevent that. And the shift from defined benefit to defined contributions pensions, fewer pension funds investing in VC, would aggravate this negative shift to indirect to less access. Maybe the mutual funds will step in here, we don't know. So the question is, who can really invest in unicorns? And I slipped out this morning and tried to get you a picture of a unicorn, because that's sort of difficult to pin down, right? What's a unicorn really? And I went into Washington Square Park, and I was lucky. So they're getting rare, but they're still out there. So what I worry about is that differential access will widen income inequality. Thomas Piketty obviously writes books about these things, and he talks about the rich having access to better investment opportunities than the rest of us. And if we have fewer companies in the public markets, maybe we're aggravating on that trend. All right, so to end, we mentioned one positive potential externality, which goes back to my first negative externality, but I've changed the word here. Maybe we'll actually have more investment, more innovation, more job creation when companies stay private or go private. So maybe it's the opposite of what I claimed earlier. Maybe all else is not equal. And what I have in mind here is that by going private, or by choosing not to be public in the first place, companies give themselves the opportunity to opt out of this quarterly earnings rat race that some people say leads to short-termism. So maybe we'll have less short-termism, we'll have more long-termism, we'll have more patient capital investing in companies, which could then lead to what's beneficial for the economy as a whole: more investment, more innovation, and more job creation. And there's some evidence that private companies are actually quite good at taking the long-term view. A couple of years ago, I published an academic study that McKinsey then very kindly condensed into one slide, which I've not managed to do in my career. And what this one slide shows is that public companies invest much less than private companies and are less sensitive to changes in their investment opportunities. And this is what the slide looks like. If you compare similar public and private firms, same size, same industry, then the private firms outinvest the public firms at the same point in time, same industry, same size, by a factor of at least 2. And as their investment opportunities improve, it's the private firms that are very responsive to those improvements and ramp up investment, whilst the public firms sit on their hands and are much less responsive. So this is not proof of anything, but it's indicative of perhaps there being an interesting difference between public and private firms that might be consistent with short-termism. So, because I'm out of time, the takeaways are, we should only really care if there are externalities. There are a bunch of externalities that I can think of. I'm sure we can add to this list. I can think easily of a number of negative ones, maybe with, if I'm hard-pressed, of some positive ones as well. With that, let me hand over.
Thanks, Alexander. So we have 5.5 minutes before our first coffee break, and so I'd like to invite any questions the audience may have or quick comments. There are a couple microphones. If you could use those, just because those that are watching remotely can answer questions. So if you have a question, please ask. And I'm going to start off with a very quick question. I noticed, particularly Renee, in your slides, you talked about a lot of outsourcing. Some of the capital intensity activity may be occurring outside of the U.S., and if that's a reason to go public. I mean, there's a question also for future panels, is how should we think about international companies wanting to list in the U.S.? Should we be concerned about their access and thinking about remedies to reviving the capital market? Should special consideration be given to foreign listings, or if we just solve the IPO problem domestically, does that also solve it internationally? Or any of you?
So I've written a number of papers on this issue. Now, the foreign companies coming to New York is a great story of the 1990s and part of the 2000s. And it occurred because of the strengths of the US capital markets. Now, in my papers, one part of the story is that it occurred because of the strengths of our regulatory apparatus and our laws. Now, our laws make us attractive on how we enforce them. And so that's a big story. Now, if foreign companies don't want to come, might be a concern, but remember that we were well ahead of foreign countries, and foreign countries are catching up to us. Now, you would expect that. That's kind of normal. They grow. I mean, we can't keep them down. So that's going to lead to fewer companies coming to New York than would otherwise. But remember that in the early 2000s, now all the discussion was New York versus London, and we wrote a paper about that. That's over. No, London is over.
Sorry, London.
I would like just to add one thing to that from a slightly different perspective. It is not that we see U.S. companies flocking to other countries to do IPOs. Okay, so it's really not that you're saying, wow, they're doing so well that our companies are going there. Just to put a little bit different perspective on this issue.
Question?
So we're a family office, and we invest in process engineering and logistic technology and so on and so forth. And we evaluate doing public and private all day long. We argue with our banks all day long because we shame them to put $10 to $100 million at any given time. And when I look at this yet evidence, because one of the companies that is listed, we are taking private, by the way, because we saw absolutely no value in them being an IPO. We have been watching this Regulation A since 2015 with great observation, but we are not seeing much EVA. Has any of the macro discussions come into a bit, and maybe this is a question also for our associates at the SEC, that if companies meet a certain type of an EBITDA revenue threshold to allow more accessibility of pre-IPO financing that will mitigate the issue of, look, it is just not worth the legal compliance cost to do a Reg A or so on and so forth. I mean, I was hoping to see a potential envelope of pre-IPO enablement to further along.
So the question is on pre-IPO enablement and other things that could be available for smaller companies because it's not worth their while otherwise to go through the typical IPO process. I do think it's going to be something that's going to be addressed on panels 2 and 3, but any last response to that question before we get coffee?
I would just say that it's consistent with the notion of making private firms look more like public firms. Okay, then whether it's listed or not may be secondary.
Just one thing on this. When I mentioned dividends, taxation of dividends, just to make sure that we are all on the same page here, my statement was to make them tax exempt at the corporate level, not at the personal level. Obviously, making the public markets more attractive would help, but it wouldn't resolve your problem. I think with Ronnie, I have a bit of a disagreement in terms of making private companies more like public firms. If you end up with just private companies, then all the things that Alexander was talking about would take place. Now, where does the price discovery take place?
And perhaps to just conclude that, I think one of the issues that arises when you allow more access, this is what I would call it, for investors to pre-IPO companies or for ever private companies, is investor protection. And I could imagine that the investor protection would have to be thought through very carefully and end up being relatively onerous. And if that were to happen, we end up in a state of the world where you have a lot of regulations surrounding even being a private company without any of the liquidity benefits of being a public company. And I view Reg A plus as perhaps falling into that category as is.
Great, thank you. And before we part, just want to let you know that this is being live tweeted at hashtag SECNYU 2017. If you'd like to participate, but let's give a warm thank you to all of our panelists. Take your way back to your seats for panel 2.
Hey, Tom Braithwaite, nice to meet you. Are we off? Yeah, there's some technical problems. Welcome to the second panel. Starting shortly. Now. So given the drought of IPOs that we've been speaking about, I'm pleased that we're going to conduct a live IPO here and now because we have Sequoia, who owns most of the venture-backed companies that are yet to go public. We have NASDAQ, which will list them. And we have Steve who advises them. Adam, just stay out of this one. We'll get Airbnb public by the end of this panel. But perhaps we can actually start with you, Chris, because you do have a portfolio swollen with these massive private tech companies which you've failed to deliver to the public market. So why not? Why are you depriving us from getting our hands on them?
Sure, thank you. First of all, it's a privilege to be here, so I'm very honored to be asked, and thanks very much. I do want to say, my comments will represent my own comments and my opinions, and not that of Sequoia. And I guess, Tom, in part reaction to your question, one of the things I think about, I've spent the last 25 years of my career with a very large focus on China and Asia. 10 of the last 25 years I've lived and worked in China and Asia, worked in the capital markets. And the one word that hasn't come up so far, which I'm a little bit intrigued or surprised about, is globalization. The word globalization has not been mentioned. And I think a lot of the underlying trends that we've been talking about in terms of asset productivity, the size of firms in public markets, the disaggregation of asset classes is largely driven by globalization. We see that in the Silicon Valley, and we see that in our sector, in the venture sector, because there are unprecedented historic levels of private capital in the marketplace with which to invest. And there are unprecedented levels of foreign private capital coming into the marketplace, coming into the Silicon Valley, which actually a lot of people are trying to measure, and it seems kind of impossible to measure, very hard to measure. And so there is this unprecedented aggregation of private capital, looking for homes. At the same time, we see unprecedented levels of cash on the balance sheets of large companies. In my world, I wake up and go to bed every day in the Silicon Valley thinking about technology companies. So there are some technology companies out there that have more cash on their balance sheet than the treasuries of most countries in the world. So there is lots and lots of cash on the balance sheets of companies. And companies are paying premiums, again, unprecedented premiums, to essentially take companies private, to engage in M&A, and to take public float out of the marketplace. I think Morgan Stanley has estimated that right now the net public float coming out of the marketplace is something in the range, a run rate of about 100 billion annually, which is 5 times historical levels. And that's as a result of these unprecedented levels of private capital. And so that's driving asset classes to become more disaggregated, and activity that once took place in the public markets is now taking place in the private sector. And so frankly, a little bit of a contrarian view to what I think what was stated in the previous panel, but I would say that the competition for the benefit of the consumer or any potential harm to the consumer as a result of lack of innovation, lack of companies competing, that's taking place in the private marketplace now. It has just shifted down, and public markets are frankly taking less of a VC role.
So you're saying it's more an availability of private capital, the fact that Uber can get X billion dollars from Saudi Arabia when presumably a decade ago it would have already been public. That is the big game changer rather than a particular problem with the IPO market. Yeah,
I think that's right. And I think consistent with what all of the other panelists are saying is, these are large macroeconomic forces that are here. They're here to stay. It's part of globalization. And I think that we need to be asking ourselves some different questions. I think there are plenty of things we can do on the margins. I think Commissioner Pior said in his words, there are things that we can do on the fringes to be helpful. And I'd love to talk about, and I'm sure other panelists have lots of ideas as to what we can do on the fringes. I'd love to talk about what we can do on the fringes for our own sector, the venture sector. But I think there are other questions that we need to ask ourselves, like what does it mean to be the best, the most reliable, the most transparent, the most enviable capital market in the world, where all the largest companies in the world want to come to, and at the same time, these large companies are engaging in this huge practice of consolidating public market capital. What does that mean? And, what kinds of different regulations or disclosures, if any, do we want to think about? I think some of those are the new questions we need to ask ourselves.
Can I just expand on Chris's thoughts? I think it's a misnomer to say that because private companies are staying private longer, they're going to be that way forever. If you're venture backed, Chris is not in the, and his partners are not in the nonprofit business. So they, ultimately, if you're venture backed, you're heading to a liquidity event, no matter how big you get, because those investors in those private companies need to show returns to their limiteds, and their limiteds are more and more patient, as evidenced by the fact that companies are staying private longer. But ultimately, those limited partners of venture funds and all investors want liquidity. So I think if you're taking private capital, and in particular if you're taking venture capital, you're on a path to a liquidity event, like it or not, and there's really only 2 types of, or maybe 3 types of liquidity events. Private equity, although the private equity investors ultimately need liquidity, so it really boils down to 2, M&A and IPO. Right. Yeah, and I think the conversation to have is really not around, these companies are staying private forever and bemoaning that. It's really the question of, should we encourage an earlier IPO event, and does regulation have a role in that? And should we somehow encourage as a society more IPOs versus M&A?
Right. I think that's absolutely the right question. To me, it's not private forever, it's private for longer. And private for longer has been a theme for the last several years. If you look at, for instance, the average age of a of a company that goes public in 2016, it's 10 years old. In 1980, it was 6 years old. In the early 2000s, it was like 4.5 years old. So you're seeing that trend. What that allows the companies to do is do two things. One, more time to fail. More time to pivot your technology, more time to figure things out. And secondly, get bigger and get stronger. And the public markets reward companies that have bigger market caps, bigger earnings. If you have a market cap of $500 million, if you're a tech company, you trade maybe 2 times forward earnings. If you're over $1 billion, you trade 4 times. And so it's much better to stay private longer to get critical size. So when you do enter the public markets, you're in a healthier spot, you're more competitive, you don't kind of end up as an orphan asset on an exchange trying to figure out what to do next.
Okay.
Yeah, if I could.
Oh, go on.
Yeah,
Well, let me ask one first, Adam, on this, because overnight there was a story that Pret a Manger was heading for an IPO, and during our first panel there was another story that it already attracted private equity bid interest. So it seems, there is such a strong private-to-private market that seems to be swallowing up a lot of these deals. How do you evaluate the relative attractiveness when you're looking at exits for your companies?
So I think most people today look at, it's all a question of valuation. And our firm is a long-term owner of assets, but the point was made, it's a fair point, that ultimately we need to create liquidity for our limited partners. We have long investment horizons, probably 5 to 7 years for a North American portfolio company, for instance. But there's a date that we need to return capital. So when we look at our options, we look at 2 things, or 3 things. We look at a trade sale to another financial buyer. We look at a strategic sale to a conglomerate or to another company in the space that wants to grow. Or we look at the IPO market and we see what the valuation is. So it's a factor of what valuation can you attain in each place, and then how do you de-risk your asset, right? And sometimes you'd like to just take your multiple, crystallize it, and sell. So we had several M&A transactions this year. We've also had several public market processes this year. And I think valuation and de-risking is probably the fundamental thing that we look at as a firm.
Is there a reason why IPO might be less attractive now than it has been in the past as an exit route?
We're private equity, so our firm often has companies that are very large and will necessarily be digested by the public markets. Most of our companies have sophisticated financial systems in place, so the Sarbanes-Oxley compliance isn't that big of a deal. Half of them, went private to start with, so we kept the systems in place. Many of them have publicly traded bonds outstanding, so they're up to speed. So it really just becomes a question, I think, for us is how do you maximize value? How do you make sure that you're transitioning the ownership of that company to a good steward of capital going forward for their employees and for society? And then finally, how long will it take you to exit is the other kind of question.
Yeah, I just want to pick up on Adam's point about large capital being more attractive to the market now than smaller capitalized companies. Going back to what Renee and Alexander and Ronnie were saying, the smaller companies are not as present in the market as they used to be. Should they be, is really the question of this entire day, as well as a much longer-term dialogue. We think that the way the U.S. markets are set up today is very good for large companies, less good for smaller companies, and we look forward to dialogues like this, talk about how we might change the way the markets work from their current sort of one-size-fits-all structure in the public markets to accommodate a middle range of companies smaller than the ones that we see listing today. And just for the benefit of the audience, yes, NASDAQ loves IPOs, and I hear wear that public market hat on, but we also run something called the NASDAQ Private Market, which provides liquidity events for private companies, both for their employees and for their, starting later this year, for their fund investors. So
well, can you address that latter point? How much, it feels to me that it was a big deal prior to Facebook's IPO, for example, the secondary trading of shares, but since then, how big is the private market now? How big is the sort of liquidity events that you're bringing to these companies?
Well, they're certainly smaller than the IPO events. So over the last 5 years, you're talking about $4 billion of transactions in liquidity events. Last year, IPOs in the U.S. were $19 billion. So are you in the same zip code? Yes. Is it smaller? Yes. We haven't started doing fund events, and I'm not talking at all about private-to-private fund transactions, which make that number much larger. These are just the sort of events we're involved in.
Steve, you were involved in the sort of Jobs Act debate prior to it being made law. What impact has that had, if any, on the current state of the IPO market?
Well, I think the Jobs Act was a very hopeful thing. I think the actual benefits, I'd say, were incremental. I think it had a larger impact just on how people viewed the regulatory climate. Things like confidential submissions and testing the waters, I think, are both used widely today. I think they're a really good tool for companies exploring the public markets. I think they're an example of where you can make changes that encourage capital formation without impairing investor protection at all. I think both of those things do that. And I think accommodations beyond that for emerging growth companies, maybe scaled disclosure, and perhaps with the new administration and the new staffing at the SEC, maybe we'll see Jobs Act 2 and broader accommodations for emerging growth companies. So I think even these incremental changes that are helpful and reduce costs, as I mentioned, can have a profound effect on sort of the environment and how CEOs and board members sort of view the capital markets and the attractiveness of the capital markets. So I'm hoping that's a direction we'll head into.
Do you think a regulation is the answer? How much of an answer is it to the current drought, or is it a side issue?
I think it's. I don't think it's the cause. I mean, I sit in a lot of board meetings of unicorns and other kinds of companies, and there's no CEO that's going to say, look, we'll get a much better valuation in the IPO market, but we're going to get acquired because I don't like the cost of regulation. I mean, their board members and their investors are going to say, sorry, we're going to take the value maximizing path because we're going to have people like Adam and Chris and his partners on board that are going to force that. Having said that, I think that at the margin that can make a difference, and certainly for the CEOs and the founders themselves, particularly right around after Sarbanes-Oxley came out, there was just sort of a sour taste in everybody's mouth about, gosh, this looks cumbersome and difficult. And so when they sort of do the risk-adjusted analysis of, is it better to get acquired right now than sort of do the marathon for a couple more years, it'll change that dynamic. Yeah. So I think regulation's part of the issue. I don't think it's the major issue.
Yeah, I think that's right. I'll just build on Steve's comment. I also happen to spend 27 years in the Big Four, and I'm a strong believer that institutions like the SEC, frankly, like the Big Four, are part of what make our capital markets great. I mean, our capital markets wouldn't be great if it weren't for the SEC and the kind of rules and transparency we have built into our markets. But I interviewed two of our, one CFO, one board member of our portfolio companies who recently went public, and just anecdotally, they would both agree with, I think, what Steve and what a lot of people here are saying, which is that regulation is not the problem. It's not the hurdle. There are these other larger market economic factors, globalization and so forth. SOX is not the big problem. Having said that, it would be great if it were easier. It would be great if it were cheaper at the margin. We have one company several years into their public float, about $100 million revenue top line number that incurs $2 million worth of SOX costs. It's enormous. But the anecdotal sort of agreement among the folks that I interviewed recently was that the regulatory impact of requirements to get listed, things like SOX, for sure has made them a better company, has made them a better operating company. There is somewhere in the range of 30-ish% of those requirements that probably aren't helpful. Overall, helpful and made them a better company. It would be really great if some of the noise level stuff could be pared back.
But if you want to think about regulatory reform, I think that I agree with you that people love to talk about SOX, but very few people make decisions based on SOX. Right. So that's not an impediment. I look at the Jobs Act, and so our group at KKR is responsible for raising capital and taking all of our public or our companies to the markets, including on IPOs. And so we're working with our management teams for 1 to 2 years in advance of a process, and then we're leading much of that process alongside banks. The Jobs Act for us was a bit of a game changer in terms of process and ease of use, and it made the IPO a much safer and more viable opportunity that we could pursue in parallel with anything else.
Because you could file confidentially.
We could file confidentially. We could test the waters. You know, we operate globally too. In Europe and Asia, there's a whole cornerstone investor process that accompanies any IPO. We've now been effectively able to take that same market practice, which has some real legitimate capital raising benefits to it, and bring it to the U.S. public markets. And so we value that. The confidential filing allows us to get ready, smooth an IPO out, and then access the market when the market is there. And you can look today at Dow's at 21,000, S&P's over around 2,400. We've been it's a massive bull run in equities, but it's been punctuated with very significant market shocks. And so when you're looking to take a company public, you got to kind of get the market time correctly, and you got to be in a position. And the Jobs Act and the confidential filing allows us to do that. The only thing we kind of scratch our heads at is say, like, why is there a $1 billion revenue cutoff? Why can't this be the case for all of our companies?
Would that lead to a net addition in the number of IPOs, or just make life easier for you?
I think it makes life easier for us. I think it creates a more fluid process, and it allows us to position our companies for an IPO. So if there's an opportunity IPO, we're there to take it.
Okay. Good. What's the international dimension here? You mentioned other countries. It was, depressing, though I suppose realistic, to hear from Renee in the first panel that London is over, I think, so it's my home country. But
that's what I get for taking my phone out of my pocket so it doesn't ring.
That's your fault. That's Uber trying to contact you. And yet, we've seen IPOs in the US from Asian issuers who like the fact that they can do multiple share classes here. So anyone want to speak to that and where we think we stand?
I actually have a view on that, and it's going to go back to the first thing I said, which is, I think, talk about the Chinese IPO. I think the biggest driver of where people are going to list is valuation and what multiple. And so just to throw out some, in China had moratoriums on IPOs. They had 5 moratoriums in the last 6 years or 7 years that shut down the IPO window 40% of the time. So I think you look at the mass influx of Chinese companies coming to U.S. markets, some of them just didn't have a place to go, and they could go to the NASDAQ, for instance, because the regulator in China wasn't allowing new IPOs. When the IPO markets were open, you can go look at the Shenzhen Stock Exchange, the Shanghai Stock Exchange. Companies were trading at 70 times multiples. In the U.S., it would be 15 to 20 if you're Dow, and maybe 30 to 40 on average if you're in the NASDAQ. And so anyone that could go float at 70 times multiple is going to do it there. And so I think that was the driver. And I think if you look at what's happened this year in Q1 alone, there's been about 140 IPOs in China between Shenzhen and Shanghai, and I don't have the NASDAQ numbers, but I think there have been about 15 on the U.S. And so I think what you're finding is people are going to choose their market by valuation, and market access is a primary matter. And the U.S. is going to be the market of choice if you don't have another place to go.
Yeah, I think just to build on that, we spent a lot of time, I spent a lot of time thinking about the Hong Kong China market as well. And I think that anything that we can do to help U.S. markets, to help New York compete, have a competitive advantage against the Hong Kong China market, I think is a good thing. The valuation that Adam, you've pointed out is exactly right. The valuations, the multiples in Hong Kong, just about for every sector, particularly fintech, is just far outstrips the U.S. at this point, and that's only going to exacerbate. I was told anecdotally, I don't have data to support this, but I was told anecdotally by a banker in Hong Kong that they estimate that 60% of the current market cap of Hong Kong, it will increase at least 60 or 70% over the next 5 years as channels of capital and windows in the PRC open bigger and wider. There's just going to be more capital coming in, particularly from the PRC, into Hong Kong, looking for places to park and willing to pay higher valuations. So I think we have to think about, that's the kind of question I think we should be asking is, how do we compete against that, and how do we make it easier? I wouldn't at all suggest that we should rest on our laurels and say it's a slam dunk that major companies from Asia, China, Hong Kong will want to be in New York. I think we see that trend, and I think we need to do everything possible to nurse it along. The dual share aspect of New York, I think, is a competitive advantage, and I think it's terrific. And I think it was a huge aspect of getting Alibaba here.
Terrific, unless you're a small shareholder. Snap reports for the first time today, and you don't even get a vote with those shares. So,
well, it's a competitive advantage to attracting the best companies here, because what's going to continue to happen is the consolidation of capital and the consolidation of market float. And I think the more that we can encourage that to happen in our markets, the better.
Yeah, if we can talk on dual class for a moment, it is a response to Alexander's point about long-termism. It may not be the best tool out there to get long-term perspectives, but it is a tool that works under the U.S. construct.
i.e. to protect founders and management from...
To allow founders and management to make long-term decisions, not to protect necessarily or entrench.
Yeah, it's certainly viewed by institutional investors as sort of the new bad boy of corporate governance. I mean, we see that, but I think private ordering and they do have a vote. Snap shareholders, they can sell their shares, and I think that I would prefer to see let the private markets and private ordering figure this out, and ultimately I think it will. I think for the first 5 or so years to have a founder be able to say, look, I want to be immune from activist investors when my venture funds distribute. I want to be able to follow this vision. Investors can then decide, look, do I want to invest in that or not? Right. I think there's a dialogue going on between institutional investors and some of the private community about what should be the limits of dual class. I mean, how long, what period of time, when should the provisions sunset? But I'd prefer to see the markets decide that as opposed to listing standards or other regulations.
Yeah. Okay. We saw a lot of slides showing M&A accounting for a big chunk of the decline in listed companies. Does anyone have a view on that side of the equation? Because
it's actually, I think that's a really funny point. I mean, it's the issue here is twofold. There's more companies going away and fewer being created for the public markets, we're part of that ecosystem. And when we look at where things are, I mean, today in the last few years, valuations have been all-time highs. So and earnings growth has kind of slowed, and so if you want to continue to grow in your company, the best way to do that in the last several years has been through M&A. And so we've actually seen a lot of M&A trades. And if you're in private equity, what we've seen as a corollary of that is there have been fewer public to private opportunities because buyers are swooping them up. In many cases, there are foreign strategic buyers coming in to take advantage of the U.S. And so M&A plays a very significant role in that. I think the question that we'll start to see, and as we've as a firm been looking at sort of the macro trends in the world, I think globalization is an open issue today. I think the question is, will globalization persist or will regionalization continue? I think you've got these massive conglomerates out there today, and if you look at some of the empirical evidence, conglomerates actually don't perform that well. Multinationals underperform their regional peers. And so from a thematic perspective, I think there's an open question, should some of these conglomerates start to break apart, and that could be taking pieces out of them and private equity buying them. It could also be spinning off. If private equity buys them, there's an option to re-IPO them in the future. And so the world may not be all that bleak. There may be a green shoot somewhere in this deconglomeration theory if it actually proves out. But there could be some trends that lead to companies coming back to the public markets in different ways.
Okay. Chris, do you see this as in some way a timing issue? Do you think how many of your big companies in the next 5 years are going to IPO? Because we have so many massively rich unicorns now. It just feels like, to me at least, that there will be a tipping point. We've seen Snap this year, but we're going to presumably see Airbnb and others in your portfolio go, aren't we?
I think that's right. I wouldn't predict, certainly not a time certain point that it's going to happen. But I think building on Steve's point, it's going to happen. There will be exits, whether it's in the next 5 to 10 year time frame. It's hard to say. But these companies have great value. They are incredible innovators in the marketplace. They are sorting through the winners and the losers, even within their subsectors and business units. And it's going to happen. There's no question about it.
Okay. Steve, what's your sense of talking to the companies that you speak to? Do you feel we are a few years away from a pickup, or what? Do you forecast an improvement on the current trajectory?
Yeah, I think we'll see pickup this year, and I think it's already happening, but many of those have either confidentially submitted, so we can't see them, or they have organizational meetings going on now. So I think you'll see some of these companies, these very large valuation private companies, start to look at the capital markets, particularly now as people think that the markets are receptive to that, the valuations are attractive.
What is the pressure from investors and employees, which we haven't really discussed, for there to be an IPO, for them to get some liquidity? Does that feel like it's generally building, or is it sort of case by case?
It's case by case with each company and with each group of investors. I think funds like Sequoia are patient capital by and large, and they'll do what's best for the enterprise and as they try to build value for themselves and their limiteds at the same time. I think but as I said earlier, I mean, ultimately venture investors need liquidity, and so the CEO that says, "Hey, I want to stay private forever," probably isn't going to have his or her job very long if they're venture backed. So you're on a path to liquidity. I think the employee liquidity thing is more pronounced, and frankly one of the bigger problems of large private companies, because you've got employees now that have worked for 5, 6, 7 years, a time period where Apple and Cisco would have already been public and provided their employees with liquidity. And so these are employees, particularly in places like Silicon Valley and New York, where things are expensive. They want to buy a home, and they really then they see their shares becoming highly valued, so they want to take advantage of that. So that's very difficult. We still don't have a good mechanism for that. The private companies, there's a wide variation in conduct, but many of them resist it. They're private. They want to be private. They want to control who their stockholders are. They want to control the 2000 count, so that they're not forced into public reporting. So I'd say that's a problem yet to be solved, and private companies are solving it in a range of ways. Some say, look, can't trade. Some do tender offers to their employees, organized tender offers. But I'd say that's one of the larger problems. Employee liquidity and demand for liquidity is one of the larger problems that big private companies have today.
Is there more you can do, Frank, to address this need for liquidity while companies stay private, or are you just happy for that to be a pressure point to get them to IPO?
No, we're not happy for it to be a pressure point. It's an opportunity for us. It's essentially providing a service that's not that different from what we do in the public markets. So we organize liquidity events, which are essentially auctions with the company's involvement in who would participate in the auction. Sometimes considerations around the price where the auction's allowed to take place. And as Steve was saying, they're really designed to address primarily the needs of employees who may have life circumstance demands for some equity to be sold. Life partners are also sometimes a significant reason. You've been busting your tail 16 hours a day for the last 5 years. I want to see something for that sort of thing. So it is a partial solution. It is not a complete solution because these are not open market transactions by any means where you can sell if the trading window is open or not.
I think in the previous administration, the SEC had started talking about some concern about some of these private market transactions. Should we be concerned at all for end even small investors getting involved in this? Steve, I'm addressing you. You're the lawyer in the room.
Yeah, I think it is something to keep your eye on. I think there are companies that are doing it very well with disclosure, good disclosure, and making sure the transferees are accredited. I think there's also, there's been abuses in the market. I think it's hazardous for unaccredited investors. There's no disclosure standards per se in secondary market transactions. I think the viable platforms, the highly viewed, reputable platforms, I think, do a good job of this, like NPM does. But I do think it's something to watch, and the companies are concerned about it too. If you're a big private company, the last thing you want to have happen is your individual employees are frustrated and they go out there and the shares are saleable. They don't have restrictions, let's say, either securities law restrictions or contractual restrictions. Some do, and they don't want to see these secondary transactions occurring, particularly where the number of shareholders gets out of hand, or the disclosure isn't there because the companies are worried about aiding and abetting liability for lack of disclosure. So it's I think it is something to keep your eye on. I mean, we do have the anti-fraud standards, but I think and I think the good companies are thinking about it hard and trying to do a good job of maintaining their stockholder base in a credible way and providing even disclosure.
Okay. This number of shareholder issue. So when I do a tour of the Valley asking VCs, why there isn't more IPO activity, a lot of them bring up the Jobs Act and the fact that threshold was raised. What's your view on that, Chris? Is that holding IPOs back? And if so, does it not bother you, or would you like to see it eliminated altogether as any sort of driving force to an IPO?
I think for us it hasn't been. I think for us we think more about whether the company is really ready for an IPO, as opposed to the number of shareholders and whether we're bumping up against or high or lower than that. I mean, to be candid, we, I think, spend a lot more time trying to assess and be satisfied that a company is really ready. The last thing we would want is for a company not to be ready.
Right, but some of your big companies would already have had to IPO in previous years. It was a factor for Google's IPO. It was a big factor for Facebook.
That was probably, when it was a 500, it may have been more true. I would look at the development of the private capital markets globally, but in the U.S. in particular, which I think have really changed the last decade with the increasing size and sophistication and global reach of sovereigns, with the same thing happening with large public pensions here in the U.S. who've developed their own direct investing platforms and aren't as reliant on GPs themselves. The advent of the family office it's a whole new institutional investor class, many of whom are significantly larger than the largest hedge funds. All of that is fueling private capital that can come in and be there for private companies that offer interesting growth prospects. And this is also a world where returns are relatively low and people are chasing growth. And so you never needed to go and reach broad to get capital. You just need to get deep. And so the 500, the 200, or 2,000 wasn't, in my mind, going to drive you to a place to just get capital. I think it's more accidental that you cross the threshold. And to me, forcing somebody to IPO early just because they happen to have too many people in their share register is a very dangerous thing. The companies don't perform well, the markets don't function well. We talked about having subscale companies, and they don't trade well in the aftermarket. Go back to the stats. If your market cap is below 500, you may trade down, and if it's above $1 billion, you probably trade up. And so you want to have the right company go public at the right time. You don't want to have an artificial trigger on it.
If I can add to that, I mean, imagine yourself on a board of directors and you conclude this isn't the right time to go public because you don't have the controls or the predictability, and it's not in the best interest of stockholders, but there's sort of an artificial barrier that says, well, you're not ready, but you have to go public. I just think that's a bad thing to force a company to go public. And I would go further to say that the one piece of unfinished business with respect to 12G, which is the 2,000 shareholder limit, which by the way excludes employees, is that we should also exclude accredited investors on the theory that companies can issue stock to accredited investors without mandated disclosure. So why is it that an accumulation of a lot of them all of a sudden triggers the need to become a public reporting company? So I don't think that makes sense from a policy perspective, and I'd love to see a new Jobs Act 2, a revision to that regulation that puts even more control in the hands of boards of directors by excluding also accredited investors from the count.
Let me just, for the record, say we supported the increase from 500 to 2,000, and as well as what Steve was just speaking about, removing accredited investors from the count. We don't benefit if a company comes public before it's ready.
Yeah, and I think we would support that as well, and I think that goes along with the whole theme that I was referring to is we want great companies to be ready. We want to help build great companies, and just so much of the competitive environment that is going on, the battles that are going on to find the winners, is happening in the private marketplace.
We're prepared to be more generous with questions than the stingy last panel, so we have 15 minutes left. We've got plenty. Let's go for it. Gentleman at the back first. It's here.
A question. It's just interesting seeing that Steve is sitting next to Frank, because I was involved at a brokerage firm doing a lot of this pre-IPO business, starting with Facebook and then Palantir and then Lyft. I don't know if anyone knows this, all roads lead to Wilson Sonsini. I'd never heard of Wilson Sonsini, but if you want to trade pre-IPO paper, you better get to know them quick. Every ROFA, every employee secondary that trade goes through their hands somewhere, somehow, and I would imagine that they actually know the market better than NASDAQ private market. They have the pulse on which companies can sell, like Uber can't sell anything, Lyft can't sell. Lyft is generous to the employees, they can sell. But the vehicle that most of the individuals are using are SPVs, and they're 3C1s for 100 investors, for accredited investors. No accredited investors going direct on the cap table of any of these companies anyway. Impossible. Then the 3C7s, which are qualified investors. So if you actually look through these SPVs, there's actually hundreds more investors than everybody knows about. And it's a huge market. It's an unregulated market. We have Commissioner Piowa here. He basically said he actually even thinking of reducing the definition of an accredited investor, which I know FINRA doesn't like because it's still on a FINRA committee, to allow mom and pop Americans to participate in these huge markets, which are global markets. So, question, comments, particularly for Steve.
Yeah, thank you. I don't know whether I should be happy or sad about that comment. I mean, we don't have 100% market share, although I wish we did. There's a lot of good firms. I think the SPV thing is an issue. I mean, those form for the purpose of the investment. I agree. If people are gaming the 2,000 shareholder account, you have a special purpose entity formed for the purpose of the investment that aggregates a lot of unaccredited investors and puts them into investments without good disclosure, and advice. That's not a good thing for anybody. And I can tell you, my clients don't want to see that happen. They want to control the shareholder base, but yet there's this pressure, that we've talked about up here to get liquidity. And of course, the market, if there's a pressure, the market's going to find a way. And I think there's entities that do it well, and I think there's always going to be those unscrupulous, folks that take advantage of that demand. But that deserves, I would say that deserves a look at regulators, where particularly if unaccredited investors are sort of being lured into those kinds of investments, I don't think that's a positive thing. I think that.
I think most of them have to be accredited for 3C1. There's no unaccredited by rules. I'm just saying the Commission has discussed reducing the definition of accredited investor for private placements in general. Not me. This is coming from the Commission or the new Commission.
Yeah, and I think the point about SPVs just underscores the dangers with tripwires in general. Someone can game the tripwire, someone can comply with it, and then you have a competitive differential that you never intended to have.
Can I make one?
If you're quick, Chris, we're going to get on.
Well, I mean, I've heard several times people talk about mom and pop investors not being able to participate in venture, and a significant amount of the investors in venture, certainly for us, the vast majority of our investors are public pension funds, universities, charitable institutions, NGOs, not-for-profits, the vast majority of our investors. And so there is a huge, tremendous amount of value flowing from the venture sector and certainly Sequoia into the mom and pop sector. Helping kids get educations, helping to do good things around the world, helping universities operate, and so on. So again, I think the question, it depends on how you ask the question and how you're thinking about moms and pops benefiting.
This is a question to any one of you. To what extent has central bank zero interest rate policy led to essentially LBO of the listed companies? In other words, an unintended consequence of zero interest rate policies.
Maybe I'll take that. I mean, the low rate environment that we're in has created asset inflation, and that's also created cheap debt that allows it to lever up and buy assets. LBOs are very financeable today. The corollary of that is valuations are also extremely high. So the bar is pretty high to get a deal done. Actually, we've seen our activity levels decrease in the last several years, in part because the strategic bid from M&A has been there to compete with private equity, for instance, or valuations are just so high you can't make the LBO math work, even if you're paying extremely low interest rates on your debt. So that's it's a very strange phenomenon you have. I think that's also why you see the markets where they are today. When you see the Dow at 21,000 and S&P's at all-time highs, it's because the asset bubble that we've kind of created with a low rate environment. It's also fueled the private markets, which is people are out there stretched chasing differentiated returns. They're chasing yield, they're chasing growth, and the best place to get that today is in the private market because it's harder to get it in the public market outside of some very specific sectors. And I think one of the other constituencies you guys sell to is mutual funds. Mutual funds have been buyers of VC in the growth stages, and I think what you see there is you see active managers that are trying to beat benchmarks, and the only way to really create that real alpha is to get an Uber in there, to get a Facebook in there, and you can really outperform what your benchmark is, and that's often the passive indexes.
Who's next? Lady here. Sorry, microphone on its way for our remote audience.
What about the small cap companies that were mentioned, like in the first session? Is it just a matter of demand, that demand is not there anymore in the public markets, or is it also a matter of supply? Is there even have these companies grow faster because of globalization, like what was mentioned before? What is your theory on that?
We think, in our views, there are a number of obstacles. As some people have said, it's not just regulation. There is an ecosystem you need to support small companies, and that ecosystem is not as vibrant in the United States as it could be. So we've laid out some thoughts last week on how to change that, but it's a very holistic blueprint on a host of things we think should be addressed. To put it as simply as possible, what our proposal essentially says, listing markets ought to be given more flexibility than they have today to decide how a market for smaller companies should be organized. And that would apply to NASDAQ, all our competitors' listing market that doesn't exist now, potentially. And we laid out in that blueprint, here are things where we think legislative change is needed, regulatory change may be needed, maybe SEC, maybe a different body to make this work. We're not just talking from totally a blank page. In 2009, we got regulatory approval to create something called the BX venture market, which was a venture market in the US. We never launched it because the constraints that were necessary for that to fit into the legal and regulatory environment were such the business model wouldn't work. We run a venture market in Sweden that we are very happy with and think is quite successful, and we're really drawing on that experience as we think about how something might be structured in the U.S. to suit smaller companies that we get in the markets today.
It's just to add on to that. It's interesting how things have changed. I mean, I think Intel and Cisco went public. They were about 30 million in revenue, give or change a little bit, maybe a couple $100 million in market cap. I mean, the $30 million revenue companies I represent, the investment banks aren't calling on them, the major investment banks. There's just an assumption that there's no way those companies can go public. And I think it's a combination of expectations in the market by investors about predictability and scale. And yeah, in part to offset the cost structure of increased regulation, that plays a role. But I also think the institutional investors just expect a caliber of company now that's much larger than it was in the 80s. So it's not even in the vernacular of a company that size in Silicon Valley anymore that we would approach NASDAQ or the New York Stock Exchange. They're talking about how am I going to get my late stage capital, get to 100 million in revenue so I can do $1 billion market cap IPO. I mean, that's kind of what's going on now.
So is it that these companies just go public later, but they still go public, or is there like this whole bunch of like small cap companies that have no way to grow because there is no capital for them?
Chris, there's got to be one for you. Do you have these companies out there that you've got in your portfolio, or do they not exist anymore?
I don't think it's a question of supply of small companies. I don't think there's a crisis of innovation and creation and development of small companies. I think it's as Steve and others have mentioned, there's a difference in terms of the support, the institutional support for these small companies and how they enter into the public markets. One of the ways that you can understand that or prove it, and certainly something we think about in our business, is the huge proliferation at the bottom of the stack of our business, which is angel investing, seed investing, scout investing, incubation investing. And if you look at that piece of the venture and private equity stack, it has grown enormously and exponentially because there is just so much for them to do. And so everything has been pushed down the stack. Everything has been pushed down the public stack, into private equity, down the venture stack, down into the angel stack. Everything has been pushed down.
Yeah, I want to agree with and refine, if I can, one thing these guys said. Our growth market, Sweden, 40% of the volume comes from online brokers. It is a retail market. It is not an institutional market when you talk about these small companies.
Gentleman here and then.
I'm hearing the venture capitalists say that regulation doesn't play a big role in reviving the IPO market. So I'm wondering why the exchanges and the SEC are pushing this de-decimalization agenda. So this is primarily for Frank, but the others can chime in as well.
I think what people have said, it's not regulation alone, as opposed to regulation doesn't have a role to play. I think what we saw with the de-decimalization agenda is that the ticks, in terms of the efficiency of the market, now I'm just really talking as an economist, so it's price efficiency, trade to trade, the trading increment, the tick size matters. And Europeans have realized that, Japanese have realized that. The U.S., we have a penny for every stock above $1, except in the tick size experiment, de-decimalization, as you call it.
Let's try squeeze a couple more last ones in, if we may. Gentlemen here.
Thank you. I'm interested in alternatives to the VC IPO path. What percentage of companies go public on the big markets in America that are not VC-backed, angel or something else, such as you alluded to? And also, is there a possibility for something like London AIM or TSXV for companies in the U.S.? You alluded to something NASDAQ's done. Might we see that in the future?
No, it's a possibility for something like NASDAQ, like London AIM, but it would have to be more integrated into the markets than London AIM is. London AIM isn't ideal.
They have no coverage. It's the living dead if you list there, I know.
Percentage of VC-backed companies? There's Jay Ritter at the University of Florida has good data on this. It's publicly available.
Percentage of non-VC backed.
Yeah,
That's
well,
large.
both is on the
About 60%.
Yeah. That's
you. Gentleman here.
So you've all alluded this in different forms, but institutional investors with long time horizons, are searching for yield. Private equity is flush with cash, record levels of dry powder. Corporates are flush with cash to go out and do M&A. So from an ownership perspective, you're looking for liquidity. You can have price discovery in the private markets, clearly, because there's capital to do it. So why underwrite the tail risk of an IPO and a lockup period and having to ride out 3 years of volatility is really ultimately the question as to why private is potentially more favorable over public. It's stated as a statement, but it's truly a question.
Maybe I'll start with that. I mean, I think it depends on what you're looking to do. If you're looking to get capital to grow, you can get that in the private markets. If you're looking to get capital to rotate out some of your shareholders, but not all of your shareholders, you could probably start to think about doing that in the private markets. If you're looking to exit your entire company, and KKR's got some very large companies, it's clear to us that the only way to do that is through the public markets, and so you've got to get out there and do that. Alternatively, if you don't have a strong other option like M&A, but the public markets are open with the evaluation, our view is get public, run a good company, and then find the way to monetize. So you don't really run that much risk as long as you have a good sturdy company that's ready for the public markets, it's of scale so you're not orphaned, and you have a capital structure that is suitable for the public markets, meaning in our case we've delevered enough to be attractive to the public markets. And so we look at a here and now moment when we're making a decision, do we sell or do we IPO, and that's a valuation decision. But for us, an IPO is not ultimately a risky thing to do because it gives you the runway to exit over time. And I think some of your companies that are growing, you have a much longer runway before you need to do that.
One last one in the back.
You mentioned very briefly boards of directors and their decisions. Elaborate a bit on how important are boards to the equation or decision-making process?
One for you, Steve. This was the importance of boards to this big macro picture.
Well, I think they're hugely important. Boards of the private companies. I'll just sort of talk about my corner of the world, which is largely venture-backed companies. I mean, these companies are owned predominantly by venture capital funds. Those venture capital funds appoint representatives to their boards. As companies start scaling towards an IPO, they'll bring in independent directors for a variety of reasons, help with business needs, but also to start to meet the listing standards and SEC regulations requiring how boards are composed and independent directors. So I'd say it's huge, and by and large, and founders do, depending upon the company, maintain some control, but most of that control is in the hands of their venture capital board members. And as I said earlier, the good ones do the right thing for the businesses and stockholders, but ultimately they need to show a return to their limited partners, and that's why I think they're all on a path to a liquidity event. And by the way, M&A is not a bad result because it returns capital to the limiteds, sometimes even sooner. Those limiteds, through the venture capital funds, reinvest in new businesses. So I don't really bemoan the fact that there's M&A liquidity events as well as IPO liquidity events, as long as that capital recirculates into the ecosystem. And I sound like a bit of a plug for Chris here, but I think we haven't talked a lot about the venture industry, but I think in 2011 it was responsible for something like 20% of GDP growth. I don't know what it is today, but that'd be something to keep your eye on if you're really concerned about this entire ecosystem as a healthy, vibrant venture capital business.
We're out of time. Thank you very much.
let's go ahead and take our seats for the third and final panel.
This is the most exciting panel of the day. We've spent a couple hours looking at the problems in the IPO marketplace, and now we've invited a few people that are going to solve those problems. So welcome, gentlemen. Thank you for taking the time to be with us today. I think what I'll do first is give each of you a little bit of a chance to sort of comment on some of the things that we've heard this morning about the problems in the IPO marketplace. I, for one, my head is swimming a little bit after the 2 hours that we've just spent talking about the various things that seem to be dragging down the IPO markets. And so I want to give each of you a chance to sort of give us the one or two top things that you think are problematic. Tom, I want to start with you. Tom Farley, in the middle, is the president of NYSE Group, which includes NYSE, but also a number of other equity and options exchanges. Tom, previously at ICE, oversaw the development of several initiatives in the OTC markets, and he also has experience in investment banking and private equity. So Tom, you've been around the markets for a while. So from your corner of the financial markets, what's your take on sort of one or two of the biggest problems that are contributing to the lower number of IPOs?
Sure. Thanks, Rick. And thanks for all the hard work you and your office do. And thanks to my friends and regulators at the SEC for having me here today. This feels a bit like home to me, maybe because my apartment is about 1 block from here. So I knew the commute well, making it here from the exchange. Let me just go back before I go into the problems, maybe do 60 seconds on something more uplifting, which is why do we care? You know, this idea of securitizing assets really was kind of professionalized by the Dutch 4 centuries ago. And the Dutch sent a Brit over named Henry Hudson, who was the one who first settled New York as a Westerner. And he dropped off a number of people right there and established the first settlement in New York State. And the Dutch then dug a trench up Broad, right to the corner of Wall, and they established it way back in 1610 as a central marketplace of this new land. In 1789, that's why George Washington went to the central marketplace, because it was still the central marketplace, and he raised his hand and he became the first president of the United States. And it was right there from an apartment overlooking that same crossroads that Hamilton wrote the National Financial Plan, the first report on the public credit that said, let's aggregate states' debts, let's create a national financial plan, and boom, the economy took off. And immediately, entrepreneurs like Hamilton, they were self-dealing even in those days, started companies. Hamilton started Bank of New York, and he did so from right at Wall and Broad. He raised money and created a bank. And very soon there was a whip-smart entrepreneur down in Baltimore who figured there was a safer way to light the streets than whale oil. Whale oil is very, very dangerous. You actually had to go kill a whale to get it, for starters, and inefficient. And this guy said, well, geez, I can use this thing called Gaslight. And he came to the corner of Wall and Broad, and he raised money, and he invested in that company, and created jobs, and created a more efficient way to light the streets. That company is still listed on the stock exchange today, 191 years ago. Or Honeywell, when it listed at 2,700 employees, now it has 140,000 employees. Sears Roebuck wanted to be the Amazon of its day. They had this great idea, I want to deliver into rural areas, but I need some dough. So they came to Wall and Broad and they raised some dough and created this national phenomenon, and on and on. Ford Motor, I want to mass produce a vehicle for even more people, improve more lives, but I need to raise money. So Ford came and raised some dough, and then they go, and all of a sudden you could get health care right away. You didn't have to jump on a horse-drawn carriage to get to the nearest health facility. And we had a company last year, Penumbra. I love this example. It was just a little company. It's kind of the kind of company we're talking about today. And they make a stent that you put in a stroke victim's heart after they, or their blockages, their veins, arteries, after they've had a stroke. If you do it quick enough, it can remove all negative after effects. My grandmother died of a stroke. And this is a company that had this great idea, but they had to have money, and so they raised money and they go make the world a better place. So I like to ground myself sometimes because we have these policy debates like, why does it matter? It matters because the free enterprise engine, perfected here in America, has improved lives for 225 years and has been a model for the world. So now, kind of go back to policy land. I'm sure it's been talked about today. I just arrived. But the number of public companies is down by around about half. If you look at the 20-year period starting in 1994, I believe is that data. But it's down. And I would argue that's a social bad. But yeah, you do have to look deeper, and there's many layers there. For example, the aggregate market cap in the public markets is up by 3 times. So the average market cap of a listed company is up by 6 times. So it's working in a manner of speaking. It just seems to be working better for very large companies. And I do think it's important to ask, why is that? For a whole variety of reasons, and I'm sure you've hit on all of them. And so I won't hit on all of them. But for example, wealth creation of a newly public company, a smaller company, we want all of society to be able to participate in that, not just on the wealthy, the elite, the more sophisticated investors. Because the evidence shows that public companies create the majority of jobs that have been created in this country, so on and so forth. So, the question is, why is that? I would love to sit up here and give you a pithy answer, but it's not easy, and it doesn't enable a pithy answer, or if I did, I would be being trite. It is very complicated and complex, and nobody knows the right answer. And in fact, if you look, as I have, and I'm sure many of you in this room who have a particular interest in it, if you look at research on the topic of why is the number of public companies down, from very smart people such as tenured professors that say this institution, there is no consensus. So let's start there. I'll give you my view, and then we can debate it. My view is that private companies are less likely to go public for 3 broad reasons, kind of 3 broad buckets, and they're not in a particular order. One is private companies look to the public market and they're afraid of what public ownership means to them and to their business, the ability to make great long-term decisions. One aspect of that is the quarterly focus. I personally am not too focused on that particular issue because, look, I'm part of a public company too, and investors do a fairly good job of balancing near-term earnings with what are your long-term growth prospects. In fact, in our most recent earnings quarter, if you look at the questions that we got, most of them were about, hey, what are you doing for the long term? What are you doing to grow your organic growth rate over time? But nonetheless, there is clearly a nearer term focus in the private markets than in the public markets than there is in the private markets. But a related issue there is this rise of activist investors. Institutional investors getting more active in voicing their concerns about how a business is run. I want to point out, activist investing has done some very good things for our markets, because if you were to go, and if we were to have some of our activist investors friends in this room, and they heard me say that, they're not a timid lot, and they would say, wait a minute, what do you mean we're bad? I said, no, you're not bad at all. In fact, you're good. And they said, we are protecting against crony entrenched management teams, and we're making sure that the investor is taken care of. And I agree. Within reason, though, we need to arm the listed companies with information. I'll give you an example. We require shareholders to publish their ownership information 135 days after they first may have actually accumulated that ownership position. Feels a little bit lengthy to me in the day and age 2017. In addition, we require them to publish their long information, long this stock, but not their short information. Seems odd. Why wouldn't that be symmetric in this day and age? And with respect to options reporting, any of the mathematicians in this room, or even anybody basically well-versed in Finance 101 knows if you buy an option to buy at a price of 20 on a $20 stock, that's very different from buying an option to buy at a price of $2 million on a $20 stock. The way it's reported in many cases is the exact same. I own 100,000 options on this particular stock. That doesn't strike me as particularly fair. So do we like investors that vocalize their opinion and are protecting shareholders? Absolutely. Do we want it to be a Game of Thrones where there's kind of hidden information? No, that doesn't seem appropriate either. The second kind of broad area that I'll mention is regulation. That's an easy one. People, everybody a lot of people you talk to will throw out regulation, and indeed I do think that is part of the issue. But again, it's tricky, and I can't give you a pithy answer because Sarbanes-Oxley did a lot of good. And in fact, having the average public company with a slightly larger market cap is probably a good thing. Because when you have those smaller, a lot of those smaller public companies, sometimes you can get the everyday investor invested in some companies that maybe aren't as well run, they don't have as good corporate hygiene. So having a slightly higher market cap may be a good thing. So I'm not saying throw out Sarbanes-Oxley and start over, but for a small company, it's really expensive. It's really time consuming. So sure, Coca-Cola, they can do it. It's not a problem. But if it's creating a barrier to a company going public because of the cost, let's look at it. And let's expand some of the things like the Jobs Act protections. Let's make it a bigger revenue threshold. $1 billion might sound like a lot. In a 1% margin business, $1 billion of revenue, that's not a lot. That continues to Dodd-Frank. What we saw in Dodd-Frank is there was a social agenda. At least for the first time in my career, it became more of a social agenda. And look, the laudable goals of, let's say, conflict minerals are noteworthy, and I want to highlight those. Nobody wants to see children or adults exploited in the name of profiteering. So this isn't a heartless Wall Streeter saying let's get rid of all regulations and let's allow unfettered bad behavior. But the conflict minerals rule it's impossible for many companies to comply with, and it doesn't provide helpful information to investors that allow them to make better decisions. That's just one example. I'd put the pay ratio rule in the same bucket. It's not terribly helpful. And then finally, I do think so you have activists, you have regulation, and I do think that leads to, and it's hard just to say what's causal and what is not causal. There is this environment that's dwindled for investing in smaller companies, and that's both the investors themselves and the surrounding broker-dealer community. I would submit it's most likely a result of some of those other policies, so maybe we should look at fixing those. But we need to acknowledge that just because we get more small and mid-sized companies going public, we may not have solved the problem for the long term if we don't understand what is driving the individual investor to invest in those companies, what is driving the investment bank to actually cover and write research on those companies. So that was a long-winded answer. I won't filibuster you again with the stories of Alexander Hamilton, but those are kind of the issues as I see it.
Right, and we'll get into some of those things as we start talking about some of these solutions. Robin, I wanted to turn to you. You're the managing director, and the head of tech, media, and communications investment banking at Oppenheimer. And prior to Oppenheimer, you had a wide range of experience in investment banking and M&A, with particular emphasis in digital media and the tech space. So in those roles, you handled a variety of public and private financings. So I want to give you a minute just to sort of give us your top list of what you think is impeding IPO activity.
Thanks very much, Rick, and thanks for having me. I've spent the best part of 22 years, after a couple of years here on Wall Street, out in Silicon Valley. My whole career has been about connecting growth equity investors with deserving growth companies, particularly in the technology sector. And so I've sort of lived and eaten and breathed this space for a long time, and I think every day about how to get my clients in the corporate banking, on the corporate side, access to the best capital. I think that, in that career time frame, the bar has moved dramatically. The first IPO that I worked on was for Brooks Automation, a semiconductor wafer equipment manufacturer in Massachusetts. We did a $30 or $40 million IPO. It had a couple of $100 million in market cap. It's, I think, still a public company today with a couple of billion in market cap. And they raised money to
fund R&D and to fund growth in the business and product development and innovation. Some very different reasons why most of the companies I'm taking public and went public last year are going public today. And in that case, it's mostly to access liquidity for their shareholder constituents. And there's now a very wide spectrum of shareholder constituents in the cap table. Private companies today look very different than private companies did in 1995. They took Brooks Automation public. So, I mean, I guess I, to some extent, question the premise of the panel, which is I'm not sure that we need to revive the IPO market. What I see is a shift, as everyone here has discussed this morning, in the point to which a company goes public to a much later stage. So we're seeing fewer, more mature, more predictable and visible businesses coming public. That's a good thing for individual investors. It's a good thing for the economy. Much of the weeding out that we had to do in the 90s in the public markets, where you took a cohort of 10 semiconductor capital equipment companies and figured out over their public life, their first 5 years of their public life, which ones were going to survive and which were going to die, is being done in the private markets. I think somebody mentioned that on the panel this morning. And I think that's a good thing for the ecosystem as well. And so, you know, at the same time, for many of the reasons we discussed this morning, there's an unprecedented access to capital, growth capital, capital fund innovation, capital fund R&D. And I see the capital markets as very robust, very healthy, and you know, capital has been allocated and is being allocated to deserving companies across the spectrum. It just so happens that these days it's happening more at a private level than with public companies.
Thanks. Connor, we'll give you a shot here.
Okay.
You're a director at McKinsey & Company's London office, which we learned this morning. McKinsey's now well known for cramming a lot of Professor Lundquist's data onto one chart.
It's not all there. There's a little of it missing, but we are very good crammers.
You're good crammers. So you founded McKinsey's investor and private equity practice in the EU, and you are also a founding member of a committee that oversees McKinsey's venture capital activity.
Yes.
You've advised corporate boards on strategy, including whether to pursue an M&A exit or public exit. So with that experience, give us your minute or two on.
I'll do so. Well, look, actually, I'm here also to report on the goings-on of a self-help group called Focusing Capital on the Long Term, which brings together some corporate leaders and chairs and also some very large institutional investors. And in its name, you'll see what we think the challenge is for public markets. Now, whether we're having enough IPOs or not, I can't really say. But I think there is benefit in making public markets more attractive to corporations and to corporations who want to build a strong future for themselves. Observation one I'd make is that those stirring stories from the past when people came to the markets for money, that's not what's happening now. And indeed, that was evident this morning. It's not to raise capital people IPO. It's to allow their employees or venture capitalists to exit. So corporations don't get from the markets, as they did in the past, capital. What actually the market provides them with is governance or stewardship, the people who vote their shares. That's what the market provides to corporations. And right now, we think it's too short-term in its outlook. Of course, people are interested in the long term, but there's a deal of evidence that suggests that corporations are underperforming their economic potential because they are behaving in a way that takes account of short-term pressures. Now, two sorts of evidence. One is you go around, do surveys of chief financial officers or CEOs and ask them, if you had a positive NPV project that was going to cause you to miss your earnings guidance, would you do it? And the answer is no, they wouldn't do it. Now, economic theory says they should do it and explain to the market why this is a good idea. But, you know, the academics do these surveys, it comes back in again and again. Asking people their opinion is one thing, actually seeing what they do is another. And Professor Lundquist's data was very interesting in that regard because he compared matched pairs, public-private companies, same size, same industry, and looked at their investment patterns. And you saw it all compressed into one slide there. The private companies were adding to assets at 3 times the rate, roughly, of the public companies. But more importantly, they were investing in a way that was 3.5 times more aligned with investment opportunity. And I seem to recall he measured investment opportunity as recent sales growth, which isn't a bad one. You know, if you're growing fast, you probably want to invest more. What he didn't mention this morning, because I couldn't cram it all on one slide, was he then looked at that 3.5 times more likely number, and he split it by industry. And he found it was a lot worse in industries where the share price was very sensitive to earnings news. The difference was much greater. And in industries where the share price wasn't that sensitive to earnings news, the public and private investing looked more similar. So you can see a bit of a smoking gun there. What's happening is, instead of investing when they see opportunities, people are distorting their investments so that they hit earnings news. Okay? And that's a big difference now between public and private companies. So if you want healthy corporations helping the signals they're getting from markets to be more about the long term, perhaps, and less about the short term, I think is very important. Now, I can report in from, the self-help group that is focusing capital on the long term, what corporations believe they can do and what institutional investors believe they can do, even without changes in regulation. But then the regulators can decide whether or not they want to help them along. But maybe that comes to the second question.
That'll probably come
Those
with
are
the
my
second question.
solutions.
Yeah.
if you like.
Oh, yes.
We'll come back to that.
We'll come back to
Can I just ask one quick
Sure.
follow-up? When you say the companies are no longer raising capital in the public markets,
Yes.
I don't understand.
Well, the corporation itself, typically, when an IPO occurs, it's an opportunity for shares to be sold, but it's not new capital going into the companies to the same extent it was in the past.
The vast preponderance are new capital.
New capital.
Supermajority.
Some of the research we heard this morning was that even though they're accumulating additional capital when they go public, they're basically keeping that in cash, at least for a considerable period of time. And that it seems to be that the incentive to go public is more to provide liquidity for the employees, et cetera, instead of to fund projects within or growth within the company.
Okay, so they're raising capital. The capital is less productive than other capital that's raised in other situations. Is that the idea?
I think that's
okay.
what you're suggesting.
Thanks.
All right, so let's circle back around. Now we're going to fix this problem. So we're going to increase the number of IPOs. And the way we're going to solve this problem, the way we're going to approach it, is we're going to look at different market participants. So Tom will start with the exchanges. What would the exchanges have to do? What kind of market structure reforms would we need to make? What would the SEC have to do from sort of the market perspective to try to boost the number of IPOs?
Sure. And some of this is going to seem self-serving, and I clearly am biased. So
that's why you're here.
Yeah,
that's why you're here. We want your perspective.
And the reason why I caveat is the first one seems particularly so. When you are a newly public, small, let's say very small company, you might have a market cap of $75 million, and you will, the day you go public, be traded on something like 50 different venues, your security, just like Bank of America is traded on 50 some different venues. For Bank of America, the evidence would show it all kind of works. There's an entire ecosystem of market participants who stitch all those venues back together in a fairly cost-efficient way, and the effective spread for investors, and therefore the cost of capital for the listed company, in this case Bank of America, but that's really, I'm just using that as an example for a very, very large liquid company, it's good. It's a good setup. For that small company, that ecosystem does not exist, and those companies often never get traction. They never get liquidity. They become orphan stocks. They rarely trade, or they trade infrequently by appointment. And so one simple thing that we can do, and actually some of our exchange colleagues at other exchanges, even those who don't have listing venues or not consequential listing venues, have even said something similar, which is maybe we should look at a minimum, because there's a lot of toing and froing and arguing about should we concentrate liquidity for the Bank of Americas. I have a strong position there, but that's not what today is about. But maybe we should start with an easier question of how can we concentrate liquidity for a small security. So that's kind of one thing. And then the second thing, and it's kind of an indirect way of answering Rick's question. The second way we can be really helpful to the small and mid-sized companies is indirectly by advocating on their behalf. And so it goes back to what I said earlier, and I won't repeat any of it. Don't worry. But it's advocating for small and medium companies to look at more transparent information around shareholdings, around an element that I didn't mention, but we have very little control over as an exchange, which is the litigious environment for becoming a public company and issuing new securities. What can we do there? Because there's an entire cottage industry set up to sue companies, irrespective of whether or not they've committed a crime or a violation. And so it's really advocating on their behalf to have smart, sound policy improvements, incremental or step function.
Great. Robin, you're going to get to represent the underwriters in this process. So looking at this issue from that corner of the marketplace. We've not had a lot of discussion this morning about the underwriting activity. I guess so. My first question to you would be, how has underwriting sort of evolved in the last few years? What impacts might that be having on this issue? And what are some things that we should be thinking about that would sort of improve the environment for greater IPO activity?
Yeah, thanks, Rick. Obviously, with the advent of larger, more mature, more quantifiable businesses coming public later, IPO sizes are larger, generally speaking, and the syndicates have grown with them. And so you have more underwriters involved in these underwritings today, particularly in extreme cases like Snap and Alibaba, where there are 30 or 40 underwriters involved in the IPO. But if you just look at sort of the median IPO, where you've got 5 or 6 underwriters taking a company public, raising $100 million, a good example would be the Trade Desk IPO I did last year. Those companies are going public for liquidity reasons, as we've discussed, not necessarily to fund growth. In the case of the Trade Desk, they wanted to build a bit of a war chest for M&A. They wanted to provide liquidity for their venture investors. And they'd actually done a pre-IPO private placement with Wellington, a crossover investor, to reduce some of the overhang in the aftermarket, the public aftermarket, by buying back shares from early investors. So they'd actually perfected the capitalization of their business before they even came public. To reduce some of the sort of whipsaw effect of overhang from stock and later in the market. I think in terms of so that is healthy. The IPO market is healthy for large companies coming public and smaller companies like the Trade Desk. Access to capital is there. They had tremendous demand for their IPOs. The question is, if we're looking at how we can make life easier and encourage more companies to come public, I think of it from my client's perspective, not necessarily from the underwriter's perspective. And I think if I'm one of my clients, I'm a tech CEO or CFO trying to bring a company public, what impediments are there in either the regulatory environment or in the whole process that would stop me from doing that? And I think the biggest issue that we haven't really talked about today is not necessarily the cost, the regulatory cost. That's actually really small relative to the size and valuation of some of these companies today. The real issue is the time allocation. And so some of Tom's points earlier, I'm going from an environment where I'm in complete control. I can dedicate 100% of my time as a tech CEO founder to building and growing my business. And there's tons of capital coming at me in the private markets. Why would I take on the burden of having to reallocate 30% of my time to managing myself as a public company, talking to investors on a frenetic pace, which is quarterly is a frenetic pace. And I'll speak for myself here and not Oppenheimer when I say I think one of the most interesting things we could look at is something like AIM in the London Stock Exchange, where we reduce the reporting to once semi-annually. I think that's pretty interesting. So I think that would probably have a lot of my clients thinking more receptively to the idea of going public. Otherwise, I think the SEC has done a very good job of addressing and removing the friction from the IPO process. The Jobs Act's gone a long way towards doing it. Having a Test the Waters roadshow available to investors to really test investor interest before coming public has really helped both issuers and investors find a meeting point when the companies do come public. Being able to file confidentially has emboldened companies, I think, to go through the process of getting ready and be able to pick their market timing more accurately, resulting in more successful deals. So I guess I would compliment the SEC on what they've done to reduce friction in the IPO process. That has changed dramatically in the last 5 or 6 years, and I think it's had a positive impact on the environment overall.
Either of you have any comments on the underwriting process?
I was going to, because the point about quarterly earnings is what I wanted to talk about and just pick up on. I mean, here's my self-help list. If you
well,
so
so what you'll do,
yeah?
you're assigned the task of representing the issuer.
So
take off and tell us what we need to be doing.
Quarterly earnings, very interesting. So I'm an issuer. What am I worried about? Well, I'm probably worried a little less about raising capital. It seems to be an easy thing to do. I am worried about the kind of governance and stewardship I'm going to get. So I could go for dual-class shares so I can keep control of the future of my company. Or alternatively, let's say I'm not going to go to that extreme. I'm going to have common stock out there being voted. What can I do to make the situation as good as possible for the long-term health of my company? So that's what my little self-help list is about. And so here's what we've been discussing in this group with corporates. The first one is avoid earnings guidance. Why avoid earnings guidance? Because it's a psychological trap. Once you've made the earnings guidance, you then feel you need to hit it, and that wonderful investment opportunity that you didn't anticipate that's just come up, you don't make it. Why? Well, because you don't want to miss earnings guidance. So avoid earnings guidance. It's easier to say than to do. I've sat beside executives agonizing over how the analysts have got it slightly wrong, itching to tell them, but they decided they're avoiding earnings guidance. But I do think that's self-help number one if you want, to play isn't the right word, but to get the best out of the markets as they are today. Don't start guiding on earnings. Second self-help hint is speak about the long term. There's wonderful analysis done up in Harvard that shows the more short-term words in a CEO's speech to Wall Street, they've gathered the transcripts, they've counted the short-term words and the long-term, you can imagine. The more short-term words, they've then compared that with the shareholder register, the more likely you are to attract short-term investors, who, by the way, they then hypothesize put you under pressure for more short-term news on which they can trade. The net result of this is, for the analytically minded, if you're one standard deviation away from the average on their short-term words index, your cost of capital is 0.43 percentage points higher than the exact equivalent company. So this is a cost of capital caused by extra volatility, which has nothing to do with your product market volatility, just to do with trading, because you've talked about the short term and attracted short-term investors. So talk about the long term, not about the short term. Health warning, if you're a CEO about to do this tomorrow, the short-term investors leave you a lot more quickly than the long-term investors take up the slack. And offline I can tell you how to survive that, but it's hard work. The third piece of advice, and this won't apply to US-listed companies, but maybe someday it will, avoid quarterly earnings. Don't make quarterly earnings statements if you don't have to, because they really, in the main, are in that category of noise that causes fruitless action. Now, not always. There will be exceptions to this. But generally speaking, it's too much information. The market nonetheless processes it, produces volatility, which really isn't in the company's interest, raises its cost of capital. Then self-help number 4, get your non-execs engaged in what the strategy is and indeed in setting it. Why do that? Non-executive directors, it's been shown, who don't understand the company's strategy are much more susceptible to short-term pressures from Wall Street. Anybody who wants evidence? There's some great work done by UCLA and LSE on the likelihood of a bailout of a US bank being higher the less your non-executives understood banking. And the causal links are they don't understand banking, they pick up their worries from Wall Street, they bring them into the boardroom, they do things which ultimately aren't in the long term interest of the bank needs a bailout. So get your non-execs engaged to avoid that downside. But on the plus side, get them engaged to get what I would call the private equity premium. Private equity seems to generate, depending on who you believe, 3% to 6% per annum returns on equity, higher than public markets. And our analysis suggests a lot of this is about engagement on the part of boards, skilled engagement on the part of boards. And we did a bit of a compare and contrast in London. There weren't too many of them. We found 20 board members who were non-execs on private equity-owned firms and simultaneously on public listed companies. 19 days a year on their public listed companies. We have a lot of meetings in the UK. 50 days a year on their private equity firm. Agenda on the public listed company, number 1, compliance, number 2, succession. On the private equity owned environment, number 1, strategy, number 2, value creation. That kind of input and engagement, although some CEOs won't like it, seems to help create this extra 3 to 6% per annum return on equity, higher, even adjusted for risk, than is available in public markets.
Yeah, Tom.
And then the last one, and I'll stop
go
after
ahead, go
that.
ahead.
Don't be hostile to activists. Good activists actually have great ideas. Some activists aren't good, but to your point earlier, do engage with activists, pick their brains.
I just want to pick up on the point, it's come up as a common thread on both sides, the point about the private markets and how efficient and how effective they are. And Connor just made the point as a tip, get in on private equity. I'll tell you who can't get in on private equity. My father, retired, has a nest egg, he thinks it'll be enough to get him until the end of his life. Not any more than that. He has no access to private equity whatsoever. Second point about that, you said private equity returns are higher. That's from the perspective of the investor. I think from the perspective of the listed company, you're absolutely right, it's higher, because there is no cheaper, more efficient form of public capital than a follow-on offering in the public markets. The average discount, don't hold me to this number precisely, but the average discount to the prior night close for a follow-on transaction, and keep in mind we raise hundreds of billions of dollars in this way. When I say we raise, companies listed on the New York Stock Exchange, is about 2.5% is the discount for that equity capital, as opposed to in the private market, where there is not a benchmark for price, the discount is oftentimes on the order of 20%, 50%, that sort of thing. So I realized I have to be a little bit of a cheerleader and a realist with respect to the benefits of the public markets, given some of the other comments, many of which I agree with. Let's keep in mind, there's a social good of broad inclusion in areas with big returns. We don't have that today in the private markets, number one. Number two, being a public company affords a company some very virtuous benefits. Access to cheap capital, particularly around follow-ons, a new currency with which they can do acquisitions that they otherwise don't have to the same extent as a private company, and a certain credibility and credentialed element of being a public company, being held to a higher standard, and having our good friends at the SEC regulate you.
Let's see. Well, Robin, do you have any thoughts on sort of from the issuer perspective, things that the SEC or others should be doing to create a better environment for companies that want to do IPOs?
No, I mean, as I said earlier, I think that the SEC's done a good job of easing some of the friction on the IPO process. And I think with the proliferation of private capital, companies have more than enough access to smart capital, led in the case of some venture capitalists who are investing late stage, by very seasoned operators who can be extremely helpful to the entrepreneurs who are building those businesses. That's not the case in the public markets, and I think it's also one of the reasons that we've seen companies go public later. It may, in a sort of dollar sense, be the public markets provide cheaper cost of capital or a cost of capital, but there's an opportunity cost that's lost in that equation, and that is it's passive capital. Private equity capital and venture capital often comes with very smart previous operators who can sit next to an entrepreneur and help guide them to success, and that shouldn't be underweighted in that equation as well. So it's not just about the dollars and cents, it's also about the ecosystem of health that they're building around that growth company.
Could I just come in on that, because I think that, is the essence of it. Public markets have, we couldn't do without them. They have a wonderful democratic effect, and we've seen this in many different countries, democratizing effect. But they do need, I think, to find a way to get investors who are more engaged with the corporations to help the corporations and chivvy the corporations along. And one of the things that might be worth looking at are how the major investors behave. If you wanted markets to be better for corporations to thrive, which is my sort of angle on this, I would suggest two things. Firstly, if you look at major investors, make sure that their incentives within their organizations are aligned with the duration of their beneficiaries. So, I've worked with major institutional investors with 30, 40-year duration money who are judging their portfolio managers annually against an index. So 30, 40-year money, which is the kind of money people are putting aside for their retirement, in that young man's mind, it's usually a 35-year-old or 35-year-old woman, suddenly becomes 1 year money. And then they deem it wise to go out to see their asset manager 4 times a year, and it's become 3-month money. Do you see what I mean? So you could see how 30-year money becomes 3-month money, and sure, then the pressure is on the board to deliver against quarterly earnings which have been promised. So anything that would help institutional investors behave with the duration that their beneficiaries have entrusted the money to them for would be fantastic. And anything also that might induce them to concentrate more. The finance professors tell me you only need about 30 stocks to be diversified. There was a stewardship code established in the United Kingdom which was to encourage institutional investors and asset managers to be more engaged with companies. We got an honest answer back from a huge investor with 5,000 positions, no names, no scandal, wrote back to the regulator saying, "Dear sirs, we love your stewardship code. We have 120 professionals and 5,000 positions. We can't possibly sign up. We just don't have the resource to do it." So why do they need 5,000 positions? Should more of them not be like, say, a Warren Buffett with 20, 30, 40 positions, which is a manageable load in which to inject support, help, advice, hopefully skillful support, help, and advice, in the manner that private equity isn't perfect, but a private equity would do with its portfolio of about 20 positions.
So you brought up institutional investors, and that's actually the direction I wanted to head, because the fourth participant in this marketplace, in this ecosystem, is the investor. And so one of the things that I've been thinking about lately is sort of the investor demand for IPOs and what we could do to sort of spur investor interest, and particularly in smaller public companies, because as we heard earlier this morning, that's really where the big drop-off in IPOs has been, is in the smaller end of the marketplace. And if you think about it, if you go back a few decades, about half of U.S. equities were held by individual shareholders, households, and about 20% were held by institutions. And that has since flipped. And now about a little over half of U.S. equities are held by institutional owners, and about 20% are households. And you're probably aware that the AUM of particularly mutual funds, but other types of funds, has just really skyrocketed in the past couple of decades. But at the same time that AUM has really been going up, the IPO numbers continue to drag down. And so as I have conversations with institutional investors, particularly portfolio managers that are making sort of buy and sell decisions on behalf of mutual funds or pension funds, I really see sort of little interest in smaller public companies. A lot of reasons for that. The biggest one seems to be the illiquidity that Tom touched on, sort of on the lower end of the market. And it seems to me that if we could sort of solve some of those issues to make smaller public companies more attractive to institutional money, that might go a long way to sort of bolstering the IPO activity. So I want to throw it up to the three of you, really, to get your reaction to that idea. Do you think I'm crazy, sort of thinking along those lines? And if I'm not crazy, what could we do to improve liquidity for smaller public companies? Are there other ideas that would make smaller companies more attractive to institutional money?
The capital market, I'll just jump in, Rick. The capital markets have evolved so dramatically in the last 5 or 6 years in terms of just this public-private divide. I think we've seen a couple of very powerful trends. One, the advent of crossover investors. I think I've got several friends who are small cap growth fund managers managing $15, $20 billion funds who, 5 years ago woke up and realized, I can't bet my next 10 years of investment returns on investing in small public companies. I'm going to miss most of the wealth creation that's happening. And so they started investing privately, taking a portion of their funds and investing privately to drive alpha in their funds and to outperform their performance benchmarks. And by and large, that's been very successful. Like any new practice, it's had its ups and downs. And so I think that institutional capital is finding small growth companies, not necessarily small growth public companies, but small growth companies. And I think that the advantage there is individual investors like Tom's dad can invest in these funds. In fact, some of these are mutual fund pension fund giants who take money from individuals and work on their behalf. So they can get the benefit of having these incredibly smart managers with huge resources, research analysts, et cetera, at their disposal to make smart investment decisions and to back the companies that will ultimately become the winners in each of the sectors in which they're operating in, driving great returns for the individual investors and providing the capital for those companies that's needed to help them grow.
So I see that as, I mean, it's a positive in some respects because it helps the average person be able to sort of capture some of the early gains of some of these winners, right? To have mutual funds doing more VC activity or more private activity. The problem, I guess, is that it sort of feeds on itself in terms of we're pushing more and more money into the private space, which sort of undermines the public markets, and that worries me for a lot of the reasons that Tom described, some of the positive social benefits, I guess, of the public market.
I think that's a fair concern. I think what Chris from Sequoia was saying earlier is, there's a tension there, there's a dynamic. Venture capitalists like Sequoia, like Andreessen Horowitz, like these firms in Sand Hill Road who are backing these companies, they want to find returns for their investors and their LPs. So they're always looking for the right time to go public, and believe me, they're more often than not pushing their management teams to go public when they're ready. So when those companies are ready to go public, they've got predictability in their business, they've got visibility into the next 6 quarters, and they know that they can operate responsibly and drive returns for shareholders who are investing in them when they come public. They'll go. So I don't see that as an issue today. I think there's a very healthy dynamic there with companies timing their IPOs correctly and coming to market at a responsible period of time.
Connor, your reaction?
Well, I think liquidity is a bit overrated, if I'm
Really?
honest. So, because most of these companies actually have long lives ahead of them. I can't really speak to the mutual fund environment. I know it less well. I understand, though, that it's required to be able to liquidate its positions very
Right.
short term. So
That's
that
one of
sounds
the
like
challenges,
a
yeah.
very, very short term vehicle investing in a very long term thing called a corporation. I can speak a bit more about large institutional investors, and one of the changes that's occurring slowly there is they're beginning to think more about long-term absolute returns for pensioners as against returns versus an index, which in large institutional investor world is often called a reference portfolio. And that may gradually begin to change behavior from thinking about how do I place capital to what am I actually bringing back in to pay Mr. or Mrs. Brown's pension. And when you get that change in mentality, you start to switch slowly away from it's got to be more than 200 million or I'm not getting out of bed of placement, and more to actually how much could I actually make out of this in the long term. Because the mentality right now is what I can place and how it will compare to some kind of an annual index. But a long-term absolute return has some hope of juicing them to think about, well, what's the gain going to be rather than what I put in? And therefore, smaller cap might be much more interesting to me, as might venture capital, actually.
Tom, go ahead.
Connor mentions liquidity is overrated. I fall into the trap of being a little jargony, and I think I was the one who brought up liquidity of small cap stocks. Substitute liquidity for cost of capital, because that's what I'm referring to. And I respectfully submit it is not overrated. If you are a small company and your stock does not trade and you have very wide spreads, whether you sell shares, buy back your own shares, try to use your shares in an acquisition of another company, or do anything with respect to your capital structure, you're in a world of hurt if you have a lack of liquidity, ergo a reduction in cost of capital. I agree with what Robin is saying, and I actually think even though it's not in our commercial interest, it's a positive for society that there are some of these crossover investors. However, I'll note we should temper our enthusiasm. It's actually declining, not increasing. And of the 3 main guys who are doing it, one is substantially out of the business. So I don't think that's a panacea. I think it's a good thing. If it resuscitates, it is probably helpful. I go back to to your question, Rick, of why aren't people interested in these smaller companies? Well, in 1980, if you were investing in smaller companies, you might have invested in Apple. Years later, you may have invested in Microsoft. Right. Today, those companies, and we can name them on one hand or maybe 2, and Robin knows them all, those companies aren't public. And so the just immense, amazing, actually, wealth creation at a company like, say, an Uber has occurred in the private market. And so you've taken out kind of the massive winners, or at least many of the massive winners that you previously had seen in the private market. So the question is, you think about those guys and not Uber, and I know the press is in the room, so I'm not speaking about them in particular, but Uber, Airbnb, fill in the blank. Snapchat a year ago, Spotify, Pinterest, Palantir, Saudi Aramco, so on and so forth. What is it that would have allowed them, enabled them to make the decision to go public 3 years ago? And it goes back to the initial conversation where let's look at a litigious environment, let's look at a more symmetrical relationship between investors and management teams. That's kind of what we have to go back to, and the regulatory environment.
All right, I want to make sure we get to your questions. So who has the questions? Up in the back.
So my question surrounding...
Can you wait just a second for a microphone so the people on the webcast can hear your question?
My question surrounding what should we do to protect companies after they go public, small cap companies. And so if I was an owner of a company, I would be terrified of, number one, legal compliance, and then companies ganging up on my stock and destroying my market cap. Maybe a scenario could be that we either bar short sales in these small caps or limit the short sales so that if I have a bad quarter, I don't have the street ganging up on me. Just your thoughts on limiting short sales or barring short sales on small cap companies that had just gone public.
I have a simpler suggestion. It doesn't get us all the way there, but maybe just require disclosure of short positions. Because one of the complaints, typically of smaller company CEOs, whether real or perceived, and I'm not opining on whether it's real or perceived, is this person is talking down my stock and not disclosing that they have a short position. Sometimes it's entirely wrong, but one way to remove that cynicism is greater disclosure of short holdings.
Thank you.
Yeah, back here.
So a lot of people here today were talking about what to do with the IPOs. Obviously, it's a big discussion. I think you have to look at the small, and we're not comparing small to large and trying to get small players involved, even in the IPO. I see a direct correlation between the brokerage industry and the IPO world going down. Do you guys support, more small, companies, whether investment banking or, just brokerage firms that can do research for small? But small is not good. I mean, to do an IPO at Merrill Lynch, you have to sign your life away for them to give you an IPO. So it's hard to get if you're even at one of the big places. So that's just small to large.
Robin, you want to take that?
Yeah, I'm not sure I caught the question, but I think that overall...
The question is supporting more small brokerage companies to help support the IPO world.
Yeah, I mean, I think the elements are all there to support small companies if they're deserving of going public. I mean, when I took Zillow public, it had 45 million in revenue growing to 70 million. It was a very small company. But they had predictability in their business model and visibility in their business model that allowed them to do that, allowed them the confidence to go public. So I think, again, it really comes down to the company itself, the specific company. And if you're a small company and you don't have your arms around your business and visibility into your forecast, it's not wise for you to think about going public, regardless of what support is out there to help you navigate your potential pitfalls once you're public.
Well, I don't do investment banking. I just own a brokerage firm. So I'm trying to say, in general, do we have more support? I mean, everyone here is big. You're probably the smallest firm that, representing over here. But small companies, that are trying to help the IPO world, don't get a lot of help, with the SEC. I'm saying everything's getting big. It's like Facebook, everyone. So the small companies aren't there. Goldman, JP Morgan, the big banks. We're missing the small, broker dealer to help facilitate more business, whether it's research, whether it's bringing them public, smaller companies that people wouldn't want, or to facilitate, some of the other things that Rick was saying.
Rick.
Hold on.
So I'd like to follow up
Let's
this
do
gentleman's question. I think it's very important and disappointing that the panel has really not talked about 250 million and under IPOs, companies that in revenues, market cap. The issue is risk at the SEC. The SEC, I think, was terribly embarrassed in 2008 and has tightened the oversight and the controls, including the FINRA oversight and regulation that has limited the role of this gentleman's point about the small broker-dealer. You've killed the small broker-dealer. I know personally 10 firms that have gone under in the last year. Mine is barely hanging on. I own part of a small broker-dealer. The cost and our ability to do deals, because there's an element of de-risking what is a risk business for personal investments at the SEC. It starts with you guys. Call off the dogs from FINRA, open the doors to risk again, then you'll get some flow through. You have killed the small cap broker-dealer infrastructure, the accounting firms, the IR firms, the other people. There's only people in their 70s now, late 60s and 70s, who are quote-unquote customers men or servicing the retail environment for small caps. I know, Tom, you guys have just killed your floor trading operations for Amex stocks. Is that correct?
It's a little more complex.
All right, you might want to explain it.
But I'll let Rick answer that.
All right, but NASDAQ, the gentleman from NASDAQ in the prior panel talked about a kind of a whole list of things that need to be done to reinvigorate the small cap IPO market. And you guys really have not addressed that today. The gentleman from Oppenheimer,
Yeah.
you got to have mid-cap, you're going to have more large IPOs, and that's what you guys want because it limits the risk. But
I don't think that's what I suggested.
Okay.
But, Lev.
Sure. Since, Connor, you were going to be the issuer representative, but I'm sure maybe Tom will also have opinions about this. Are there any market structure fixes that you guys could think of that would increase issuer confidence in the sort of the markets? Maybe issues related to rebates or tiered market data and special access to market data and all these sort of market structure related problems that many in the industry have identified that would sort of boost up issuer confidence?
Yeah, sure. Yeah, from an issuer perspective, the ones that you described, I think, are a little bit less relevant. Those are more the issues you described, while important, tend to be more broker-dealer issues and kind of rent-sharing questions. But I do think, and go back to something I said earlier, concentrating liquidity on fewer venues is really important in terms of inspiring confidence. I mean, it's very complicated to trade a newly public small company when you're trying to ascertain where's the liquidity among these 50 different venues, and that would be a major market structure undertaking. I mean, essentially, it would require action from the SEC, if not Congress. And I do think that would inspire issuer confidence. I mean, right now, the amount of trading that occurs away from nationally recognized stock exchanges is at all-time highs. It's round about 40%, it's just a tad under 40% every day of volume occurs away from nationally recognized exchanges. And a goodly portion of that, I hesitate to say a majority because I'd have to go back and look at the statistics, but of that magnitude, occurs in areas that aren't even ATSs, which is a secondary, lesser form of regulation for stock trading. So that doesn't inspire a lot of confidence. Even the name, kind of dark pools for that portion. If you mention it to the man or woman on the street, and oftentimes I don't even have to mention it, gets brought up to me. Oh, you run the New York Stock Exchange. What's going on in these dark pools? So in terms of just inspiring confidence generally in society, I think we should look at where we want these trades to occur and are we headed the right direction.
All right. Well, we will have to leave it at that. I noticed that as we went through the Q&A portion, the longer we went, the more hands were raised. So
Saved by the bell.
That's right. And I didn't ask Scott what I'm supposed to do now that we're at the... well, thank you. Thank you, panel.
before you go, just wanted to thank everybody for participating. Also for our Commissioner Pivawar for not only giving the opening remarks, but also staying to listen to the entire program. For our questionnaires, if you'd like to provide your opinion on how this event took place, please feel free to turn those in.
Oh, yeah.